Over as the new CEO, replacing the outgoing Jakob Stausholm. So we'll certainly watch to see if we get any response in the Rio Tinto share price. And Volvo Cars in focus as well. They're taking an impairment charge of 11.4 billion Swedish krona. That's about 1.2 billion US dollars due to delays in some of his electric models and, crucially, Kriti, talking the T word, escalating costs of tariffs.
Well, does that T word actually have any impact on today's market session? As I said, we did see a complete 180 in that picture from yesterday. Let's take it to the test. This is, of course, the opening trade across Europe. The FTSE 100 kind of flat at the opening bell, or opening trade, I should say, of Europe. I think what's really interesting for me specifically today is going to be that tech exposure. Do we see a move in ASML? Do we see a move in SAP off of that NVIDIA story and really that softening that you see from the United States into China, at least according to NVIDIA? The stock 600 opening flat as well. Slight outperformance from the FTSE 100. Now we just wait for the French index, and that's going to be a crucial one ahead of the budget that Prime Minister Bayrou is putting forward, higher by 0.1%. Again, this is not the high-flying start to the open, Anna, that we saw from futures, but maybe that changes as things shake out.
Yeah, we'll see how this evolves this session. And as you point out, yesterday's session certainly evolved. You had the initial shock around those Trump headlines, and then it evolved to something a little bit more positive, or at least resigned to tariff headlines. Let's have a look at the sector breakdown then, and we've got banks to the top of the sector board. So the banking sector is the best performer. Oh, sorry, that's just changed. Travel and leisure also doing pretty well. Oil prices continue to retreat, 68.82. So perhaps that's having an impact on the travel and leisure space. Technology is a strong performer this morning, up by 0.5%, and that's easy to link to the NVIDIA story, to H20, the ability to ship those chips to China. No direct read across perhaps to European tech, but anything that supplies NVIDIA, anything that supplies that AI machine, perhaps liable to do well today. And telecoms is the worst performing stock today. And I'm looking for what's happening to Ericsson. Yes, and that stock is down by 2.5%, despite the fact that the numbers seem to come in better than had been anticipated. So that's a big mover there.
Absolutely. Some fascinating ones as we look across this kind of market day, because we're not seeing a ton of major action this morning. I think the ASML story is probably the clearest read-through we get from NVIDIA this morning, higher by 1.6%. And I think seeing probably the most volume they've seen around everywhere else. L'Oreal, however, is your biggest downside mover, or at least from a volume perspective as well, down almost 1% on L'Oreal shares, which, again, I think brings me right back to keeping one eye on France, one eye on what the Prime Minister Bayrou has to say when it comes to the balancing the books and balancing the French budget as well. Lots to digest. We're going to do that throughout the rest of the show and in the programming ahead. In the meantime, let's take a broader picture of where equities are supposed to go. Luis Dudley, Global Equities Portfolio Manager at Federated Hermes, joins the table this morning. Luis, pleasure to have you, as always. We're starting to get some tariff warnings. We're starting to get some hits to the bottom line. Volvo Cars is one example. We're seeing it in several others as well. This is a first 3 months after Liberation Day. Is this the canary in the coal mine?
I think, we've still got a lot of companies who are thinking that a lot of it is still not happening for them, that, they're still waiting for those prices to move. They're thinking about how they can readjust their supply chains, how they can change and really reinvigorate, their overall sourcing to ensure that they're not really passing on the price increases to their customers and also pushing their supply chains to do less. So I think at the moment we're obviously seeing inflation kind of continuing to teeter along. And so to a certain extent that gives us an indication that things aren't really hitting yet and that there's still more to come in H2, and certainly that H2 weakness is really where we expect it to come through.
How much cushion do European companies have to absorb some of those pressures? If we're not seeing it show up in margin compression, for example, is that showing up in, eating into cash reserves, for example? How much cushion is there?
Yeah, I think it is that, but I think there's also maybe some room on margin as well. I think, kind of year to date and over the last couple of years, we've had obviously wages going up and that's been compressing, but I think they've also been passing on costs, as I say, down the supply chain. But I think one of the key things, particularly for UK companies, is that wage growth that's been really hurting. And so that's really something that they're looking to try and offset, maybe through innovation, through AI, hiring freezes and things like that.
Louise, good morning. You mentioned they're UK companies. I've just broadened the UK lens a little bit. We're going to be having a few conversations today running up to the Mansion House speech by the Chancellor, no doubt digesting it tomorrow during the show as well. I mean, there could be, our reporting suggests there could be some news flow around mortgages. There could be something around financial services regulation, perhaps no change on cash ISAs because there was some pushback there. What matters to you, do you think, Louise, in terms of where this story goes?
So I think it's about business confidence. That deregulation story is something obviously the city is always happy to hear as a message, but also that confidence. We saw a bit of a wobble last week. That business confidence, how they're going to be able to fund, any potential fiscal deficit and things like that is really what people are looking to really be reassured on, as well as maybe perhaps additional spending going into some of those growth areas such as AI and healthcare.
Yeah, where do you see the pressure points at the moment? We had some data on the labour market that was a little weaker yesterday, but we had some retail sales data, perhaps helped by the weather, that was a little more positive. So as far as the UK narrative goes right now, how do you see things developing from here?
I think, as you say, it's quite mixed. I think, the services sector continues to do quite well, but maybe more on the manufacturing side, it's a bit weaker. So at the moment, really, you have to be quite specific. Certainly within the healthcare side, I think that's probably the area that we're most optimistic, where companies can really benefit and maybe don't have some of the wage pressures that other companies are seeing. And maybe from a tariff perspective are also globally diversified and can also rejig that to kind of maximise and be most efficient on that.
There's a big question, of course, ahead of this Mansion House speech, and arguably in France as well, with Prime Minister Bayrou about how that shows up in the bond market. What is the ripple effect between the volatility we have seen tiny iterations of in the bond market into the equity market?
So I think it depends. I think, at the moment with kind of valuations where they are, I think, people are looking for where that next leg of growth, and obviously that's more of an equity story. And I think obviously also on a tariff perspective, because where we are in the year as well, people are looking to be reassured about full year guidance and kind of looking into 2026 as well. So maybe less of a one story, more about that equity, that growth. Can the UK continue to deliver what recently has been kind of pretty good relative to the rest of Europe?
I'm going to put my Guy Johnson hat on and talk about the currency market as well, because he loves to say, I think he talked to some company that was talking about a potential euro at 125 and how a lot of European companies are or are not hedging that possibility. We just had our colleague Mark Cudmore talk about a potential swing back or retracement in that level. Is that something Stock 600 companies are prepared for?
I think it's hard, actually, something we were discussing on the desk yesterday, how do companies manage these kind of medium-term, longer-term contracts? Who takes on that risk? Treasury departments within companies are pretty good at doing that. And I think these days, actually we see kind of generally companies get it right in terms of hedging. So taking on the right amount of risk and therefore also kind of balancing the cyclicality perhaps of their earnings because of that.
Talk to us about the earnings story then that we're still to hear about. We're gearing up for bank earnings out of the United States. Mark Cudmore, our colleague, was saying there's quite a low bar for the earnings stories to impress this time around, and there does seem to have been quite a lot of downgrading of estimates. And you sort of put that alongside the fact that demand was pulled forward into the start of the year. I wonder what narrative you're expecting to get from the earnings season.
Yeah, so I think particularly on banks, I think we're coming into kind of earnings with banks being quite kind of relatively stable from a valuation perspective. They've done quite well in kind of the last week or so, but very much a beneficiary of the deregulation and, potential kind of tax expectations that are going to come in through the end of the year. So I think that's definitely a sector that we're quite kind of bullish around, that we expect some of those US banks to be really capitalizing on some of those areas, also doing quite well through the volatility, and also benefiting from kind of some of the M&A activity that's also kind of coming through as well. That's been quite a good year so far for them.
Yeah, and I suppose we could see deregulation then in financial services in the United States under a Trump administration, and here in the UK for probably very different reasons, but under this Labour government, trying to change things in terms of the post-GFC regulatory environment.
Yeah, I think perhaps also the UK may be looking across to the US, you know, as the biggest market, and looking to ensure that they're remaining competitive. For banks and within healthcare as well, it's so important that they think about that global landscape. Where do companies want to do business? How are they helping businesses do that better?
When we talk about, I'm going to bring right back to where we started on the tariff read-through, if I can here. 30% is a scary number. 70% is a scary number. But 30% doesn't feel as cost prohibitive, obviously, as 70%. There is a narrative right now in this market that because of the complexities of supply chains, that 30% will not in its entirety get passed on to the consumer, and therefore 30% is not a scary number. What is the line in that sand where you would say, actually, that's going to actively eat into demand for some of these companies?
So I think it depends on the industry a lot. It depends on the types of companies, the types of products that they're selling. But I don't think people are thinking 30% is going to be the number. And I think maybe the rebound that we saw yesterday, where people are like, okay, 30% is the big number, but then immediately he's kind of softening it with, oh, but this is just a negotiation. So yeah, I think it's, and to a certain extent, we've seen this before, you know, that it's a negotiation tactic. He comes out with a big number, it then gets softened. So I know from, previously when tariffs have come in, we have seen price increases coming through. Trump's obviously putting a lot of pressure on companies not to pass that on to consumers, but I think we can expect a certain percentage going on. But maybe that's a 10% that gets split out across the supply chain.
Yeah, there's a temptation, Louise, to think, okay, well, now we've got August the 1st, that's the date, then we'll know a lot more about tariffs. I wonder if we'll ever know the full picture around tariffs, because sort of constructive ambiguity around tariffs seems to be part of the playbook, and there are lots of sectoral tariffs that have been investigated or are being investigated, but certainly not fully announced and implemented yet.
Yeah, and I think also particularly when it comes to kind of critical minerals, which has been a big kind of negotiation point, those prices are continuing to be volatile. They're going to continue to affect kind of supply and demand going forward. So definitely it doesn't feel like it's ever going to be a done deal. It's going to be an ongoing playbook, as you said, in terms of that negotiation for years to come.
Okay, Louise, thank you very much. Thanks for joining us this morning. Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. A quick check on the Core 6. Guy Johnson is not here, but his pick of 6 stocks to watch here in Europe is still here. We have ASML up by 2.1%. Clearly, the temptation is to link that to the NVIDIA story, and perhaps that is exactly right. NVIDIA able, it says, to export its H20 chips to China. They were designed for China, had to be pulled back, though, on exports there because of the changing regulations in April. That's the biggest mover, really, and the most interesting one here. Schneider Electric up by 0.7%. Interesting focus on electrification and data centers later on in the day over in the United States, perhaps. Nestle and Novo Nordisk both moving to the downside. Now, let's get a check on some of the individual stocks that are moving here in Europe with a deeper dive into some of those. Here's Chloe Melly. Chloe, good morning.
Good morning. Let's start with Ericsson this morning, which is down 4.4% almost. Ericsson reported earnings this morning, and it seems that the market is not too impressed even by its profit-beating expectations. The profit-beat expectations on the back of a strong 5G market, but the company did flag some weakness related to tariffs. So that might be the reaction there, which is sending the shares down 4% this morning. Now, moving on to another part of the tech industry, the semiconductor industry, we've got a couple of rating cuts from Citi this morning on Soitec and Siltronic. So those are not necessarily household names, but they are very important key suppliers to the semiconductor industry. They provide wafers. And Citi said that there was continued weakness there, high inventories and pressure on end markets. And that is sending those two stocks down 2.5% and 2.7% this morning. Moving on to UK retail. So retail sales jumped in June. That's on the back of really good weather in June in the UK, which led people to go and buy electric fans and go and buy leisure equipment, etc. And that was really a sign that the UK economy was rebounding a little bit after contractions in April and in May. And there's a little bit of activity this morning on the back of that from UK retailers. Sainsbury's seems to be a little bit up. Tesco and Next, however, it's a tiny bit down, so it seems to be a little bit unclear what the impact is on those retail sales. And then finally, we have got Orsted's. So Orsted is up almost 6% this morning, is now has been rated overweight at Morgan Stanley. Morgan Stanley said that the wind developer from Denmark was worth a fresh look. So that is really sending the shares higher this morning.
I think I'm ready to order a windmill myself from Ørsted for this heat wave. Chloe Melly from our equities team, we thank you so much. Coming up on the program, we're going to dive into the banking sector. Wall Street's largest lenders begin reporting earnings today. JP Morgan and Citigroup first on the list. We're going to dive into what we can expect from the U.S. lenders next. Stick with us. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Welcome back to the opening trade. 17 minutes into our European session, and the gains are modest, to say the least, here in European equity markets, and non-existent in some cases. US futures, though, pointing a little bit higher. Interesting news lines around NVIDIA. They think that the US administration is going to allow them to send H20 chips into China once again. So as a result of that, we see NASDAQ futures up by around 0.5%. Let's talk about the auto sector, though, because we've had some news flow surrounding that here in Europe. European autos in focus. The sector is feeling the heat after US President Donald Trump dialed up trade tensions. Volvo Cars says it's taken a $1.2 billion impairment charge because of delays to some of its electric models and, crucially, the rising cost of tariffs. For more, let's bring in Bloomberg's Global Autos editor, Craig Trudell, who has details on this and the wider autos narrative this morning. Craig, good morning. So $1.2 billion in the case of Volvo Cars. They're putting this down to something and tariffs, but tariffs is the thing that sticks in your mind. Is this the first of a few?
Yeah, I do think that there are some self-inflicted wounds sort of mixed in here that makes this a little bit messy, but absolutely I would expect this to be the first in a trend for this earnings season. People have talked a lot about the so-called taco trade and Trump chickening out. One area where he has not done that has been in auto tariffs, and I'm not particularly surprised by that, given the fact that whenever he has talked about trade, cars has been, an industry that's been on the sort of tip of his tongue as, a way in which the U.S., in his eyes, has not been on equal footing with the rest of the world in terms of trade with other countries. He wants more cars that are sold in America to be built there.
Craig, can you just put the number into some context for us? Because when we saw the likes of Ford or GM, for example, the numbers were similar in terms of, that was just for Canada and Mexico. That wasn't for the rest of the world. How much is $1.2 billion in the context of the industry?
Yeah, I would say in the context of Volvo Car, it's a pretty big number because it's a much smaller player in the U.S. than GM or Ford are. And the numbers that, GM talked about, in particular, having $5 billion as a rough impact on their profit for this year was really substantial, right? And so I think those headlines have sort of faded a little bit, despite the fact that they were so big. We've seen maybe not necessarily a realization of sort of the worst case scenarios of car prices left and right going up, $5,000–$10,000. I think we've seen a reluctance on the part of manufacturers to sort of be the first to blink and lose share, because that's what's going to happen when you jack up your prices and your competition doesn't.
Talk to us a little bit about why we're seeing a positive reaction, though. I mean, we're talking about these scary numbers, and Volvo Cars are higher by 2%. Is that just a European summer, or is there something more to it?
I think the shares did take a hit last night, and so maybe a little bit of relief this morning. I think it's also been pretty well known that this company has had serious issues with some of its platforms, and so those self-inflicted wounds that I mentioned earlier come as no surprise to investors who follow this company closely. In terms of the tariff impact, it's really remarkable to see how sort of resilient these companies have been. Even as they've, really taken it on the chin with these tariffs, you've not necessarily seen just an absolute drubbing for this sector. I guess, the counter argument you can make there is they were already pretty depressed going into this whole saga.
Yeah, so they were really depressed. And as you point out, yes, this broke half an hour before the close, didn't it, yesterday? Right. So we did have a chance to factor that in. So that's a point well made. Let me ask you about Japan, but this is a very related topic. Just last week, we were talking about Japanese car makers announcing their export prices to the United States. They were cutting them by 20%. And this really raised all kinds of questions for us, thinking about pass-through of tariffs and higher prices to consumers. It raises the question, are consumers going to pay more for cars, or is it going to be the companies take it on the margin?
Yeah, I think any sort of strategy that's being that can be pursued at this point to try and hold off from price increases, because you not only have some manufacturers sort of holding the line, you even have some of the players in the U.S. like a Ford that for those vehicles that they make in the U.S. They're really sort of leveraging them as a sort of cudgel against their competitors. So you saw Ford come out with employee pricing. So not only would you increase your prices relative to competition that are theoretically keeping them steady, Ford's actually going in the other direction, and that is going to sort of, make its competitors, including the Japanese, reluctant to raise prices because it would mean a significant hit to their sales. I also think we've not necessarily seen some of these price increases for the obvious reason of a lot of these manufacturers tried to export as many cars as they could into the U.S. before these tariffs hit. And so, how many cars are stuck at ports and are we, sort of not necessarily feeling the full brunt of this? I think we'll hear more from executives about that in the weeks to come.
All right, Bloomberg's global auto editor Craig Trudell walking us through some of those main stories. We thank you so much. Let's go from the auto sector to the banking sector. Wall Street's 6 biggest banks kick off earnings this week, with JP Morgan and Citigroup set to report later this morning. Bloomberg's Charlie Wells is here with a preview. Charlie.
Critty, good morning. Well, look, analysts really are very optimistic for this sector. I got to show you guys a chart that I really just cannot unsee. And this is that KBW Bank Index beating the NASDAQ year to date, just speaking to the optimism that a lot of investors have on the back of that Trump-era deregulation, a lot of these changes to capital rules. Now, as far as earnings, what we're expecting is to see some strength coming from the trading side. A lot of the volatility that we've seen in this quarter has boosted some of these trading desks. If we take a look at some of the results, some of the revenue coming in from those trading desks, we're seeing on that fixed side, Citigroup really showing some leadership there, expected to show that leadership. And on the Goldman Sachs side, looking at some leadership on the equities trading side. So volatility boosting trading. Net interest income also is expected to bring in billions for some of America's largest banks. Now, this is an important revenue metric, one of the most important for a number of these banks, holding tight in this higher for longer environment. But I've got to say, if we think about the investment banking picture, that's something where there's expected to be more of a mixed bag, as a lot of this uncertainty has been bad for deal making.
So uncertainty bad for deal making, but volatility can be good for trading. And we've seen some of these share prices touching records in the sector, Charlie. What do the results, how do the results rub up against the share price performance?
Yeah, Anna, I got to show a lot of this green on the screen year to date here. All of these major banks that are going to be reporting this week up significantly this year, but do not let that mask some of the other troubles that might be out there looming in the economy. That is the word from some of these Wall Street analysts. I want to bring up some of their recent commentary that shows this divide that we're seeing. You've got this really bullish take from the likes of, say, Mike Mayo at Wells Fargo, talking about how as long as there's not a recession, these bank stocks really have room to run. Giddy up is a phrase he used a few weeks ago. Thinking about Saul Martinez, though, at HSBC, this is that more cautious take, talking about how some of those macro risks are just not priced in to a lot of the optimism that we have seen here. And if you want to take a look at one individual stock, JP Morgan, we can look at how this is playing out for some of these individual names. So you see 53% buys, but more cautious takes from other analysts.
Well, speaking of caution, Charlie, what gets in the way? What's the red flag here?
I mean, Critty, look, we've got a lot of these trade tensions, concerns that could spill over into the performance for these banks, changing the atmosphere that they're operating in. But also, if you take a look at some of the regional banks, there's less optimism. They really are lagging in the United States relative to those national peers. And I think this could speak to this issue that, sure, you've got a lot of performance, a lot of solid performance coming in from these markets businesses, but is that masking some consumer weakness? Is that masking some retail? Is that masking some residential real estate weakness, commercial real estate weakness that a lot of these regional banks are more exposed to? So I think as we hear these earnings come out, as we hear these executives talk, this is a framework to view these earnings through.
Bloomberg's Charlie Wells walking us through what to watch for those bank earnings. We thank you so much. Anna.
Yep, coming up on the programme, we will look ahead to the UK Chancellor's annual Mansion House speech with Nigel Wilson, chairman of Canary Wharf Group. That conversation coming up next. A lot to discuss when it comes to the Mansion House agenda, fiscal sustainability, fiscal commitments on behalf of the Chancellor. That's all going to be really crucially watched given the volatility we saw in markets around her appearance in the Commons not that long ago. And this is the first time that she'll be really addressing the city and addressing markets since then. Home ownership, mortgage schemes, financial services regulation, all of that will be in focus. How to get more money into UK stocks as well. How much should we worry about the UK IPO market? All of that in conversation next. This is Bloomberg.
case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting this. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. With all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? Now, the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Welcome back to the opening trade. About 30 minutes into today's session. Green on the screen across the continent. We're only higher by 0.2% when you look at Stock 600. Some volatility there, some slight changes, but again, it's a risk-on day, but not by an enormous amount. I think that's the best way to phrase it here. One of the main things we're keeping an eye on, of course, is a speech right here in London from UK Chancellor Rachel Reeves, her annual speech to London's financial industry later at Mansion House. It marks a key moment for the sector, but also for the Chancellor herself after the recent market jitters over her future. Bloomberg's Morwenna Kanium is all over the story and joins us now. What is the city looking for in this speech?
Well, they're looking for quite a few things. I think overall is going to be a commitment to boosting the City of London and in particular getting investment in the UK. So one of the things that I think people are expecting is some reforms to the tax on share sales and also this sort of one-stop shop concierge service to help companies invest in the UK. I think those are two big things that we'll be watching for. There's also a few other things that the payment system regulator being scrapped, looking for more details on that. And also some changes to the ring fencing rules as well on customer retail deposits and things like that. So those are a few of the key measures that we'll be watching for. I think also the city is going to be wary of any signs of a wealth tax, which obviously we've been discussing in recent days, and also for more details on changes to the pension system, the auto-enrollment system, and also, as has already been announced, changes to the way in which firms are expected to invest, particularly towards UK assets.
Okay, so lots of things that the financial services sector specifically is going to be tuning in for then, Morwenna. What about the broader pitch? Because as a Labour Chancellor, no doubt Rachel Reeves will be wanting to join the dots between the role that financial services plays in the wider economy.
Absolutely, and in fact today we're expecting her to make a speech actually up in Leeds before this, where she's expected to detail some changes to make it easier for people to get mortgages, particularly first-time buyers, people on lower incomes, and there's expected to be a new guarantee scheme announced. So I think that's something that she's really going to be sort of trying to pitch to boosting the broader economy as opposed to just the financial services industry.
Okay, Morwenna, thank you very much. Morwenna Coniam with the latest on what we're expecting to hear from the Chancellor later today. Let's get an industry perspective. Nigel Wilson joins us, Chairman of Canary Wharf Group and regular visitor to the programme, to Bloomberg TV. Thank you very much, Nigel, for coming to talk to us. So we just heard Morwenna talking through a host of topics that could be on the agenda then for the Chancellor a little bit later on today. Taking a step back, what do you think it's important for her to communicate today?
I think the key important point which you mentioned is actually how do we boost investment to boost growth, and that's what we failed to deliver so far. We have a very good savings culture in the UK, but we don't have an investment culture, and we have to transfer from being a savings country into an investment country. And that's going to upset some people as they feel safe in saving, but there is not enough advice and support for investment.
Yeah.
And so you need all of the regulators to join up and say, actually, we're going to be a growth economy, we're going to be investment-led around that. We have to make changes. So I see the FCA putting a hand up and saying, actually, we're going to help on advice. Actually, there's a massive advice gap in the UK. I think Nichols is going to be supportive because he's in his second term in office, so he's very much more confident than his first term, and actually give people advice so that they actually can be confident in investing and not just savings.
Yeah.
We desperately need reform of the pension industry, of the ISA industry. I think she's a bit nervous about doing that right now. I think what would be helpful is if Andrew Bailey puts his hands up and said, actually, the economy is more resilient than we thought, but there's some early signs, some early warning indicators that we're moving off trend growth. We need a boost to trend growth, so actually interest rates are going to come down and actually signal much more positively and less nuanced about doing that going forward.
Okay, yeah, maybe he's been trying that over the last 24 hours. There was some talk, wasn't there, from him about how rates will still come down, but maybe you want to see a little bit more guidance on that front. Thinking about then how we get more of an investment culture, not just the savings culture. I mean, something like stopping everybody just piling into cash ISAs, is that the kind of thing that you would have liked to see? Because that was talked about, but then perhaps shelved because of objections from some parts of financial services.
One of my big personal failures has been to try to stop cash ISAs growing as quickly. And there's over £400 billion in cash ISAs now, and there's 40, 50, 60 billion gone in, or likely to go in this year. That's just too much into savings and not enough into growth equity. And we have a lot of very undervalued companies in the UK, and people should be shifting their money into those undervalued companies rather than letting them be acquired going forward. And that's a sensible thing from a macroeconomic viewpoint to do.
You talked about, I want to hit that twofold. Let's start off with the savings bit that you mentioned specifically. One of the things that Morwenna had mentioned as something that they're looking to watch in this speech is kind of the ring fencing rules around some of those saving schemes and specifically the retail banks as well. There's a question if there is a change to that plan coming forward. What might that look like if something like that were to manifest?
I think the two parts of that. I think the default funds in DC need to have a bigger allocation to private assets.
And defined contribution pensions.
Defined contribution pension schemes. You know, this is a £800 billion industry with a tiny investment in private assets. And the private markets are growing tremendously, and there's a huge need for infrastructure investments. In the UK, just picking up this point, we're brilliant at startups. 6,000 new startups every year, funded by the EIS, SES, and VCT. But after that, we just neglect policy and regulation and tax. And so we're short on Series A, Series B. So all of these growth companies, except the best get funded by international markets and not by domestic markets. We have to change that going forward. So we not only have an investment culture, but a growth culture. We're really letting young people and entrepreneurs know that they're going to be supported through the investment system in the UK. And that can be done through the DC pension scheme. DB pension schemes don't have to hold no equity whatsoever. When you think that a lot of people are going to live for 20, 30, 35 years in a DB world, they can afford to have some of their assets, particularly where schemes are in surplus or that they can hold more equity in that. And that's another reform that could happen. And the mix between cash and gilts and equity within the ISA schemes is just wrong. it's too heavily dependent on cash and gilts, and we need it much more skewed towards its original intention, which is to invest in growth equity. It was the PEP schemes of yesteryear. But we've had a number of chancellors who started to think about doing that. In fact, Jeremy was very close to making some changes. This is a time when the Chancellor's got to say, actually, we're changing the culture. We're moving from a savings culture to an investment culture. And at the same time, we're going to support young people who want to get on that housing market, because the housing market at the moment, nowhere near hitting the targets that they've set, the 300,000 houses per year, just for England, and we're miles behind that target.
Well, you highlight this investment culture, but it feels like what you're saying is specifically the equity piece of this as well. One of the key criticisms of that from, I say, any foreign investor is that you get taxed at every single ability to even get in on that, whether it's through a pension scheme or whether it's even as a retail investor, for example. Do you think Rachel Reeves has any incentive to budge on that?
She's got an incentive to budge on that, but she's constrained. I think not, personally, because it's I think she'll have it as a budget issue. Otherwise, people are going to model what are the changes and what are the impact and what do they do for the fiscal rules going forward. And she wants stability. You know, the economy is quite resilient, but not growing. She's got some stability as a consequence of that. But there's some very punchy numbers in the OBR forecasts going forward. And a lot of the items that people want change make a huge contribution. I mean, if you just think of property taxes, at the moment, they're about £12.6 billion. In the forecast for 2029-30, they double that. That's a huge delta. If you start changing the tax on those particular items, you'll have an even bigger hole in your financial forecasts going forward. So there's a need to create more dynamism in the economy. There's a need for more investment. There's a need to massively change the culture. I think Andrew and Nicole and Sam Woods as well are much more experienced now themselves. They've been in the job a long period of time. They can see what's happening in the real economy, and they can be supportive to what Rachel really wants to do to help drive economic growth.
So these are the regulators that sort of accompany her at the PRA and other places. You talk about dynamism and wanting this more dynamic culture around the UK economy, Nigel. I wonder if it matters to you whether these are listed businesses or not, because we talk a lot about the trouble that the UK has in attracting IPOs at the moment. And is there something inherently much better about having a stronger listed economy, or does it not matter if it's held by private equity or in private hands?
It doesn't matter in big picture terms. I think we've underperformed in attracting new listed companies in here, but we've got lots of unlisted ones and private ones which are doing incredibly well. Let's celebrate that.
Right. So if we focus on the listing rules, is that too much focus there?
It's too much focus on something that's actually not going to be difficult to turn around in the short term. Whereas actually we've got loads of great private companies that are growing. We've got all these growth companies which are non-listed. They don't have to be listed quickly to get access to capital. That model has changed, and the fastest growing markets in the world are the private markets. Let's go with that, because we have a great private equity business in the UK. We have a very good VC business, but they need to be bigger and more successful. And therefore, if you spend all your time worrying about the fact that we're not getting enough listing, you're not spending enough time on what could be the real drivers of growth in the UK. We need masses of private capital to go into rebuilding our infrastructure and supporting our initiatives on transport and housing and everything else. Let's not be embarrassed by the fact that this isn't taking place through public companies, but let's make it happen anyway through private companies.
But Nigel, the point that you're making is raising the bar for taking on more risk. Private markets, although juicy right now, to your point, are hard to navigate, demand a higher risk premium than listed companies do on the stock exchange. They're not as accessible to a retail audience that is looking to either grow a pension or is looking to even have, a retail trading account with a Vanguard or a Fidelity or et cetera. Doesn't the emphasis on private markets actually raise the bar to take on more risk?
No. I mean, risk is wrongly defined. Everybody focuses on risk on 1 year VAR. The reason 1 year VAR is used is that's when I was a young man, that's what the maths and the computational skills allowed you to do, is to do analysis on that. If you're making a 10 or 20-year investment decision, you should be looking at 10 and 20-year VAR, and you have a totally different perception of what is risk over that period. So I don't agree with your premise.
A 10 or 20-year investment horizon, the way you make that, and the way private markets work, is because you can invest in scale. How do you make that applicable to someone who is not a millionaire?
Yeah, that's why the DC reform is required, actually, and for 10% of the assets to be in private assets. At the moment, and that comes through the default fund. And most people, actually, 90% of people just tick the box which says, I'll have the default fund. And you're taking away the risk for them by making the asset allocation 90-10. And 10% of your investments in private assets over the next 10 years is a good bet, not a bad bet, because it's a 10-year horizon that you're making that difference. A lot of our industries and growth industries are going to emerge over that period. And most of those businesses are private businesses at the moment. The best of them are going to be 100% funded by international equity if we don't do it in the UK.
Okay, Nigel, thinking about risk, and one of the lines we've been trailing this morning is around home ownership. We've talked a little about their ambitions, the government's ambitions around home ownership, and there could be another mortgage scheme coming here. When you hear about mortgage schemes and helping people to buy property in the UK, do you think, well, that's great, that helps people get on the housing ladder, or do you think we're just increasingly addicted in an unaffordable housing market to these kinds of government schemes?
No, we have to boost supply in the UK. You know, the government has a sensible target, the 1.5 million, the 300,000 a year, but unless it stimulates the demand at the same time, we're not going to have adequate supply. But at the same time, they can work on affordable and work on build-to-rent and social housing, and they need a comprehensive housing strategy. And at the moment, we don't have that. In part because actually, even though they've improved the planning system, they've introduced renters' rights, they've got the building safety regulation, which has now got massive problems in being implemented, and we're looking at whether we should abolish upward-only rent reviews. And all of those things act as a constraint on growth. And we've got to stop doing this, is actually saying we're going for growth and then put all these barriers in the way from delivering that growth.
Okay, thank you very much, Nigel. Really good to speak to you. Thank you so much for coming in. Nigel Wilson, chairman of the Canary Wharf Group. Great to get his perspective. Another perspective later on in programming. Alistair King, the Lord Mayor of the City of London, will be on the pulse later this morning. That is, of course, still ahead of the Chancellor's Mansion House speech later on this evening, Critty.
Absolutely. Coming up on the program, Donald Trump not happy with Russia's President Vladimir Putin or what the U.S. president is threatening to do if a ceasefire is not reached in Ukraine. That conversation next. This is Bloomberg.
Get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt-to-GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP, and that's got to be a major focus.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back to the opening trade. 48 minutes into today's session. Green on the screen across the board here. Outperformers, of course, in the DAX higher by 0.3%. But your outperformer very much is those tech stocks. The read-through from the NVIDIA story saying they can now export H20 chips to China, certainly having impact on the European tech sector as well. Let's stick with some of the policy coming out of Washington. This time, certainly having an effect on Europe as well. U.S. President Donald Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Now, Trump said the levies would come in the form of secondary tariffs.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days, tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Joining us now is Tony Halpin, who leads our Russian economy and government coverage. Tony, Donald Trump ratcheting up the pressure on President Vladimir Putin. Can you just walk us through the latest commentary from the White House?
Yes, I mean, Trump clearly expressed disappointment with Putin. He said, I think, at one point that he thought 4 times there might have been a deal on the table that Putin would accept, but it didn't happen. I'm not sure, by the way, that the Kremlin's viewpoint is the same. And from a Russian perspective, actually, this may be less of a threat than a window. They see that as 50 days in which action from Trump is deferred, and 50 days on the battlefield, of course, is a very long time, particularly in the summer fighting season. So in some measure, it may be even a relief for the Kremlin that Trump has put off this threat until 50 days from now, but clearly it's looming on the horizon, and they will have to take account of it.
Yes, and where do things head next then here, Tony? Trump is also keen to emphasize that the U.S. isn't paying for weapons for Ukraine. So he's also been saying that weapons will be sent, but it's going to be done via NATO, and he thinks the money is coming from Europe. What's the story there?
Yeah, I mean, the key point for Trump is that the US won't pay for these weapons, that Europeans will pay for them, and Ukraine potentially also will pay for them, and they'll be provided to Ukraine. And that's important for Ukraine because they've been very nervous in recent weeks that the allocations made by the previous Biden administration was due to run out sometime in this summer, and they weren't clear that they were going to get a fresh supply from the Trump administration, which hasn't allocated any funding for it. So now they know at least that they can get weapons. It's a question now for the Europeans how those are paid for, but from Ukraine's point of view, it will allow them to defend themselves against Russian attacks, which in recent weeks have intensified.
Tony, thank you very much. Tony Halpin, who leads our Russia economy and government coverage. Thank you very much for joining us. Yeah, and really interesting. He gives the Russian perspective there. And it seems to be that's what the oil price was looking at yesterday when we heard this conversation around tariffs coming to Russia. And yet the oil price went lower on action deferred. Let us talk about what else is on the agenda then for today. It's actually quite a busy day. We've got US CPI to round things out. But we start with Euro area industrial production. That's at 10 a.m. UK time. I think we get ZEW numbers out of Germany as well around that time. We get US bank earnings, JP Morgan, Wells Fargo, Citi, and the rest. So Charlie Wells setting us up nicely for that conversation a little bit earlier on. And then, as we've mentioned, Creddy, the US CPI number, Mansion House, that speech by Reeves and also Bailey. But the French budget also on our radar as something that we're watching.
It's a fascinating one because we haven't seen much reaction in French assets just yet, but there's a lot of doomsday in terms of analyst notes, in terms of the reporting around this, the idea that Emmanuel Macron is going very forcefully into the idea of a defense ramp-up, talking about things like utilizing the anti-coercion tool in reference to retaliatory tariffs into the United States, and yet doing it at a pace and at a timeline that his budget may not be able to endure. And that's where Prime Minister Bayrou's comments are going to come in handy today.
It is interesting what Macron has been saying around the tariff story, though, because you're not sure he's speaking for the rest of Europe, are you? Right. Because it sort of sits in contrast with what we were hearing from Suzanne, our bureau chief over in Brussels, who was saying, look, we're not going to see much retaliation from Europe right now. What they're focused on is trying to get a deal done by that August 1st deadline, and viewing that as still a possibility rather than Macron's line, which is all this sort of tough talk on retaliation.
Absolutely. But if it comes down to the same fears we had last summer, which is that this deficit is only growing, it's actually not getting better in terms of that, why is the bond market not reacting? Valerie Teitel, I think, has all of our answers for us and joins us now. Val, should the bond market be reacting to this, or are there other things that are higher up on the worry list?
Well, look, I mean, fiscal concerns are clearly a concern, not just in Europe. We also are seeing them in Asia. We're seeing them in the U.S. But it's funny, they seem to arise at one sharp, specific moment, like we saw with the U.K., with the Chancellor Rachel Reeves' tears in Parliament, igniting this fiscal dominance moment. So it does seem to need something to kick it off, you know, whether that announcement of the extra defense spending from France, maybe it just wasn't enough to alight concerns around, again, you know, we're seeing a decent rally across fixed income this morning. Unsure the reason why, but it does seem like things are pretty settled in French OATs ahead of this budget decision.
Right. So if the global bond market's focus is not on French overspend, it's on the long end of the Japanese market. It's on US treasuries and the long end there. Is that the global focus at this point? And we're heading into the CPI data, but important to think about where the market is in its thinking, I suppose.
You know, it's very interesting to see, for instance, NASDAQ futures at all-time highs while we have the 30-year yield flirting with 5% again. It does seem to be this reoccurring theme that we need kind of a blow-up in the bond market to then dent the equity market rally. And at the moment, you know, we're maybe flirting with levels where we start to see that kind of price action, but we're not there yet. But we could get it after US CPI today. I think the real worry for the bond market and for the equity market, Anna, is a print that shows not just a tariff pass-through into components, which we have our eye on, but tariff pass-through into a broader basket of core CPI goods, which could maybe, I guess, lead investors and lead the market to believe that retailers are getting comfortable passing on prices to consumers, passing on these price hikes, even though it might be something that's not directly exposed to these immediate tariffs.
They did it so recently, is a thing I keep coming back to, a thought I keep coming back to. You know, the post-COVID, that push up in prices that we saw in many developed markets, retailers, consumer goods companies have that in their very recent experience. You know, we faced higher costs, so we passed it on to consumers and they took it and we were able to command higher prices. I just wonder whether that muscle memory is going to kick in at some point.
Yeah, but no, in the last CPI print in last month, the components we were worried about, such as electronics, apparel, furniture, even new cars, saw month-on-month deflation. So we have not yet really seen evidence of prices coming through. The worry is that we could all of a sudden see it in 1 month. Whether the print today is going to be too early to tell, you know, we'll have to see. It's very unlikely that this will have a shift on Fed pricing when it comes to July. Yeah. I think most market participants are focused on the September meeting instead, where we will get another CPI print and more labor market data for the Fed to make a final decision on whether to reduce interest rates in September.
Kind of exciting 24 hours ahead of us. Bloomberg's Valerie Teitel walking us through some of the key things to watch, specifically in that CPI report coming out about 8:30 a.m. New York time, 1:30 p.m. right here in the UK. But of course, France also on our minds because we do have that conversation, or I should say that budget speech from Prime Minister Bayrou. We have some great conversations right off the back of that. Our exclusive conversation tomorrow with Eric Lombard, the French finance minister, right here on the opening trade. Maybe we can talk to him a little bit about the proposals that Prime Minister Bayrou has or is planning on putting forward, how they're going to plug that hole in the deficit and still steer the French economy in the right direction. But in a little over an hour, Benjamin Haddad will be joining Bloomberg Television as well. Stick with us. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
President Trump says he's open to more trade negotiations as the EU finalizes a new retaliation list of U.S. goods if talks don't deliver a deal. NVIDIA expects sales of its H20 chip to China will resume based on assurances from Washington, a surprise reversal from the White House after its earlier ban. Plus, Donald Trump threatens 100% tariffs on Russia, giving Vladimir Putin 50 days to end the war in Ukraine. So that's, of course, driving all asset classes. Stocks definitely advancing after the assurances that Washington gave to NVIDIA that they were able to resume sales of some artificial intelligence chips to China. Now, the other things we're watching out for is, of course, a busy day that will also feature inflation data and big bank earnings. Now, the picture overall, the U.S. 10-year yield, always a great benchmark to look at first thing in the morning, 4.4154. Bitcoin, look, again, a record, 116.770. Unclear exactly what function Bitcoin has, whether it's a replacement of gold or some kind of hedge against inflation, or whether it's simply because of regulation in the U.S. And then, of course, we also look at Eurodollar 116.89. In terms of the European markets map, a lot of the focus will be on that data out of the U.S. and what that means for the Fed. Also watch out for bank earnings that usually in the U.S. are a good indication of what we could see here in Europe. The DAX and the CAC gaining some 0.3%. And then NVIDIA, because it's planning to resume the sales of its H20 AI chips in China after securing assurances from Washington, is also on the up. You can see 3.7% higher for NVIDIA. So for the conversations that matter and the insights you need, let's get started.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump has indicated that he's open to more trade negotiations, including with the European Union, even as he insisted that his letters threaten new tariff rates are the deals for U.S. trading partners. Well, let's bring in our panel, our great panel, to get us started on this Tuesday morning. Aaron Captain, Global Head of Economics and Strategy Research at UBS Investment Bank, and our trade czar, Brendan Murray. Brendan, I mean, we're wading through documents trying to figure out whether this is the proposal of negotiations or is this actually a deal?
Yeah, well, I think that the whole strategy here is to keep the Europeans off balance, confused about what the president's intentions are. As you said, he said the letters are the deals, but he also said we're still open for negotiation. So the Europeans coming into this past weekend thought that they were trending in the right direction, and that they were sort of coming to some sort of framework arrangement, and then President Trump's letter dropped, and that kind of led to a whole nother round of second guessing in Brussels. They're now trying to figure out whether talks are going to get back on track. There was supposed to be the chief negotiators of both sides were supposed to speak late yesterday. So we'll see if talks do in fact get back on track. But this certainly threw the Europeans for a loop to hear that their tariff was essentially just handed to them in a letter from President Trump.
And Brendan, at the same time, so the EU has also targeted countermeasures, right? They're going after U.S. car makers, Bourbon, and, for example, Boeing aircraft. So is this in retaliation or is this a deterrent?
Well, it's a message that here's what we're going to strike back with if you do indeed go ahead with these reciprocal tariffs. There is a lot of disagreement across the European Union about whether they should engage in what essentially would be a trade war with the United States. That would be very damaging to particular industries and countries. So there's going to be a lot of debate going forward over the next couple of weeks. And don't forget, before the August 1st deadline, the EU has a summit in Beijing with China, so they have to factor that complicated relationship into the equation as well.
Aaron, I like the way actually your insights go through the 10 toughest client questions that we fielded. These are the questions that Brendan also fields every morning. And the first one is, how are tariffs impacting global growth? I mean, given we don't know where tariffs end up, how difficult is it to predict the economy?
Yeah, and what's fascinating is the market doesn't seem to care, and you look at the data, and data is getting really bad, right? So in April, we had the largest gap in 27 years between hard and soft data. So the confidence data was falling, the hard data was actually improving because of the front running. And then in May, you see that completely reversed. So you then see the soft data getting a little bit better because of the de-escalation, but the hard data at the end of the front running sort of rolling over. And if you extract a growth rate from that, you're tracking global growth about 1.3% annualized versus a long-run average of 2.8. So we're really seeing the impact now.
But Aaron, I mean, so we speak to a lot of chief executives, also off the record or at least off camera, and they'll say, look, 10%, 15% I can live with. It's anything more that I haven't modeled. So is the market looking through because they assume that tariffs will go around 10, 15% level that the president had initially started with?
Yeah, it's partly optimism about the landing zone, and I think some of our clients think it might land lower, right? And I think the mood music the last 5 days is the other direction. And then the other thing is just not seeing it, right? So not seeing the impact in the data, and particularly inflation data, then sort of reinforces this false sense of security. Oh, maybe it's not so bad. Maybe it's like 2018, 19. Now, I think that's a misread. So I think we're about 1 or 2 months away from starting to see the price transmission. It's a bunch of technical factors which we can get into as to why you're not seeing it yet.
Yeah, we'll get to that in a second. Brendan, what do we know about how the Trump administration negotiates these? So there was, for example, there's a lot of animosity towards Russia. That's very different to what we had 4 or 5 weeks ago. And it goes, again, to the tariff. So it's basically using the tariff for a political message.
Yeah, exactly. So the message that we're getting from a lot of the trading partners of the United States is that they don't really know who they're negotiating with. Are they negotiating with the U.S. Trade Representative or Howard Lutnick, the Commerce Secretary, or Secretary Bessent at the Treasury Department, who himself is very open to negotiations, where as you have President Trump, who's basically like, the letter is our negotiation, and we're just gonna tell you what the rate is. So there's a lot of confusion from on the other side of the negotiating table to the U.S. trade negotiators, that they don't really know how to deal with this situation. Is this just a big negotiating ploy, or is there actually a deal to be had before August 1st?
And Aaron, I mean, why can't we see the tariffs in the data in the U.S.?
Okay, so we're going to get CPI, right? So there's a 2-month lag between the tariffs and seeing it in the CPI normally. Now, one of the big problems is that almost all of CPI outside the 3 largest cities is only sampled every 2 months. So even if June was the print you're supposed to see in April, you're actually, a bunch of CPI is not sampled in June, right? So you wouldn't see it there. Then you have sort of complicated inventory dynamics. You have residual seasonality pushing down on the incoming data, so it's going to artificially depress, I think, the inflation print. And so really it's the July print, which you're going to get in August, when you're supposed to get a much cleaner read. Now, it could even be a bit later. There was an interview with the CEO of, I think it was Basic Fun, one of these big toy importers, and he basically said, look, we're still in the process of drawing down our inventories. We're not going to start to pass it on until September, right? So I think it's coming, but we're not seeing it yet. Now, the one thing I would advise people to look at, the Treasury has daily data on how much they're collecting. They are now collecting tariffs at a rate of $330 billion annualized. That's already over percent of GDP. This is actually getting paid, right? So this is not somehow mysteriously disappearing. These are importers already paying the tariffs, and they're either going to have to take a big margin squeeze, or they're going to have to pass it on.
But so the Fed, I guess, and Jay Powell is right to wait to cut interest rates.
Yeah, they're about to go into, we think, a 5-6 month period of accelerating inflation. Now, I think they know that. They run all the same models as we do. And so it's a trade-off between, I think, when does the labor market sort of start to ease and sort of crack, and we're seeing some signs of that, versus how quickly is the inflation data sort of increasing, and then making a judgment about, well, which of those two is moving faster and which will we respond to.
What happens to dollar?
So I think most of what's happened so far has been hedging flow, right? You do not see the rotation in the form of outperformance of bonds or outperformance of European equity. So, and I think what's happened now is the fast money community is sort of positioned for a weak dollar. They think the real money community still has to rotate, and so there's going to be some selling flow. Now, if you just run rate differential frameworks, the Fed is going to be cutting more than I think most of the other G10 central banks. So that would give you more dollar weakness. So the direction of travel is very clearly, I think, towards a weaker dollar over the next sort of 6 months.
Brendan, I mean, are the way that these tariffs put together, do they kind of save the U.S. economy, or are they at the moment blanket? So would it put some of the American companies at a disadvantage compared to others?
Well, I think the approach that the administration is taking, both with the reciprocal tariffs and the sectoral tariffs, you could say it's having both effects. The reciprocal tariffs, are going to they could be actually struck down by a court. So we don't know what the longer term future of those tariffs are. But the sectoral ones, the copper, the steel, and aluminum, we saw one on drones overnight. These sectoral tariffs will really hit the users of those commodities and those products that they can tack onto those 232 investigations. So there's going to be a pretty widespread impact over the longer term. But as Aaron said, we may not see it till later in the third quarter or the fourth quarter.
Aaron, I mean, the U.S. consumer has always showed up. Is there a danger that this time it doesn't show up anymore?
Well, so consumption has been much weaker the first half of this year than last year, right? And actually really weak in May. So when we're looking at sort of momentum, it's not very good. But we ask ourselves the same question. The last couple of years, it's all been about the top 20%, putting a floor under basically consumption. So you have simultaneously distress at the bottom end and then robust aggregate numbers. Could happen again, right? So using real income flows to forecast spending has not worked the last 4 years. That was pre-COVID the way to forecast, but it hasn't worked. So I think that's one of the things we sort of ask ourselves, is that the way we're going to be wrong?
Yeah, so the top asked questions. I mean, I really love this note. At number 6, you have, what is the evidence of rotation away from the U.S.? I mean, people talk about it, but you actually see it in the numbers.
So it was very clear in the April tick data, right? So there you could see the selling, and then since then, I think it's not so clear. And so you could look at things like, imagine you're going to reduce your position in the U.S. bond market and switch into bonds, which is 15 times smaller. Now, you should really see that in the form of a compression of term premium and boons. You don't see that at all. There's no evidence of rotation. Oh, my earpiece just fell out. There's no evidence of rotation, I think, out of the U.S. market into the European bond market. Then if you look at equity, there's been no outperformance of Euro stocks actually since April 2. So where it's showing up is really in things like the FX market, where it's more of a relative price.
Brenda, I mean, over the next couple of days, is it global tariff escalation? Is it is it all going to be like in the next 6-7 days, or could it really take for most of August as well? I think the closer we get to August 1st, and as we get the CPI numbers, the beige book is on Wednesday, the PPI report is after that. We've got earnings season now coming into the picture and adding color to how the tariffs are affecting. I think where it's going to become clearer that this is the tariffs are something of a political strategy, but they're also going to become more of an economic drag as investors and others realize that these are actually taxes on American importers that the Treasury is collecting these taxes from, and I think that's going to become clearer over the next couple of weeks. And President Trump's argument for them, is going to come under a much larger test than it has to date. Thank you both for joining us. Aaron Captain, Global Head of Economics and Strategy Research at UBS Investment Bank, and our trade czar, Brendan Murray. Coming up, China's economy grows more than expected, while exports of rare earth metals soar. We'll discuss the outlook for the world's second largest economy next, and this is Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign in Central Portugal, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back, everyone. Now, NVIDIA says it expects to resume sales of its made-for-China H20 artificial intelligence accelerator based on assurances from Washington that such shipments would be approved. Now, it's a pretty dramatic reversal from the Trump administration's earlier stance. Now, the H20 chip was created to comply with earlier trade curbs, but since April has been blocked from sale in China. Well, our news desk editor, Jill Deesis, joins us from Hong Kong. Jill, good morning. So how significant is this move?
Good morning, Francine. This is, I think, as you laid out there, very significant. I mean, remember, this is a chip that NVIDIA had originally designed in order to comply with prior restrictions on China. Obviously, that was a really big blow when the U.S. Banned this earlier this year. So the fact that we've got a reversal, I think this is indicating really two things for us here. One, really big win for NVIDIA, particularly CEO Jensen Huang, who just met with Trump last week. He's currently in Beijing, where he's expected to attend a conference. So you're seeing a pretty big victory for them there. NVIDIA, likely going to then accrue billions potentially in revenue by being able to resume this chip. But then what it also shows us is that there's a pretty significant thawing here happening in U.S.-China relations. Now, remember, it wasn't that long ago, just several weeks ago, when the U.S. and China met in Geneva to sort of work out a trade truce. That pause on certain restrictions. It's actually due to end sometime next month. Although we've already started to see some de-thawing here, obviously in the form of these chip sales. We're seeing some compromise being made, particularly so that the U.S. can facilitate China to continue sending rare earths over, continue to include that trade. I'd also point out that the U.S. Secretary of State Marco Rubio kind of indicated last week that we're paving the way for a potential Trump and Xi meeting later this year. So I think, again, this is showing us some level of thawing in U.S.-China ties, and then also, again, a pretty big win for NVIDIA here.
Jill, as always, thanks so much for joining us at Jill Deeses there with the latest on NVIDIA. Now, China's economy grew more than expected in the second quarter, driven by strong exports to markets outside the U.S. But the data also showed weak consumer demand at home. Now, GDP expanded 5.2% year-on-year. Meanwhile, China's exports of rare earths in June climbed to their highest since 2009, indicating a push by global buyers to get hold of the materials used to make powerful magnets. Now, critical minerals, of course, being used to fuel the AI boom, to power the latest surge in defense manufacturing, and as a negotiating tactic, international diplomacy. Yet in a world of tariffs and trade wars, what happens to supply chains when China dominates the critical mineral space, both for mining the raw materials and refining them? Well, joining us now is Amanda van Dijk, co-founder and managing director of the Critical Minerals Hub, and Francesca Ghiretti, director of the Europe-China Initiative at the think tank RAND. So thank you both for joining us. Francesca, let's start with you. I mean, I was surprised that, despite the trade tensions between China and the U.S., China's doing okay. I don't know whether they've managed to reform the economy or they've just been much better at engineering it.
So they haven't managed to reform the economy. Some of the issues that have been structural for years are still there. We still have a real estate crisis. We still have youth unemployment, deflation, and we still have, as we saw, lower consumption compared to production. So the structural issues are there. What really went well to a certain extent is that they expected a much longer and much more difficult trade war with the United States. And at the end of the day, they had prepared for something a lot worse, and it didn't go as bad as they thought, at least, so far. And on top of it, even though trade with the United States has been less than in the past, trade with the European Union and ASEAN countries, for example, has increased. So they're diversifying their trade portfolio, so to say, globally, which is why their economy is actually part of why their economy is actually doing better than expected.
And it also helps actually having critical minerals, because they have so much of it, right? They have about 50 to 100% of some of the metals globally, and so it helps them internally.
Well, frankly, it's leverage. You were just talking about chips. Every chip that's made has something called gallium in it. China wants the chips, but the leverage they've got is if you want the gallium to make the chips, they're the only ones that have it. So their control and domination of critical minerals markets gives them huge trade negotiating power.
So is it because they have them, or they also have them at the best prices?
Both. Well, actually more. So they don't necessarily produce all of it in terms of mining it. What they do is refine all of it. So the end product that you need to actually put into whatever you're manufacturing is in China eventually, and they can choose to sell it to whoever they want, right? They have supply chains that lead to China, and then they can sell it to who they want. And that gives them control of the entire market, whether or not they produce it.
What does it mean for trade tensions and tariffs actually with the U.S.? Have they had at the margin a better deal because the U.S. still needs so many of these critical minerals?
Absolutely. So when the U.S., for example, has just invested in a U.S.-based rare earth manufacturer called MP Materials. The Defense Department invested $400 million. But it's going to take at least 5 years before they can start producing sufficient rare earths to even hope to be independent of Chinese dominance and influence. And in the meantime, all of the, let's say, car manufacturers, EV manufacturers who need permanent magnets that come from China are dependent on China. So it's a bit of a tit for tat. You want our rare earths, you need to give us trade concessions.
Yeah, and they've made this, they've made this approach, like they've basically rechanged, as you lay out in your nice note. It's 3 major changes in the approach to the country, and actually national security and critical minerals is one of those.
Yeah, 100%. I mean, usually export controls are adopted on the basis of national security concerns. So you want to protect national security, so we adopt export controls. Suddenly, export controls actually become a bargaining chip in trade negotiations or a leverage in economic statecraft. And the Chinese have become also much faster at implementing these export controls. If we go back to 2022, when the United States adopted the first export controls on advanced chips, it took China some 6 months to adopt the first licensing. In 2024, less than 24 hours. And then we saw in May also how quick they were. And on top of that, they're also learning from the United States to implement extraterritoriality, so asking third countries not to export any component that has their own rare earths within them if they're used in military applications by the United States. So we saw a real change in how China has been doing economic statecraft and using this leverage.
And we've also seen, right, to Francesca's good point, is that actually China has also gone to a lot of African countries, some, Latin American countries, to have deals where the U.S. and others just weren't present.
Look, over the last 25 years, China has invested over $1 trillion in developing supply chains in resource-rich nations, especially in places like Africa. Some 70% of the copper belt is influenced by Chinese-owned companies, and that's a lot of influence. So if 70% of your copper and cobalt production in the Democratic Republic of Congo is owned by Chinese companies, and you want to say, okay, I want to sell to America, that's a lot of power. It's not that easy. When those commercial ties, they make diplomacy very difficult.
Yeah, and so I guess it's almost impossible for some of these countries to diversify away from China.
It becomes really difficult, not just because, the presence is so large. It's also a fact that a lot of countries who produce themselves and maybe they have their own companies, now they also have very high demand. So it's also difficult for these countries to decide to make agreements with third countries in order to export because they want to take care of their own home economy. We saw this, for example, with India and Japan recently, right? So they make it really difficult to adopt diversification strategies or stockpiling at the same time, which in theory are the sort of management strategies that you adopt while you try to develop your own production like the United States apparently is trying to do.
Francesca, overall, I mean, there's a belief actually in certain parts of the markets that it's really China that wins into all of this because the more turmoil, the more uncertainty with U.S. policies there are, then countries go to China. I mean, is the president of China the real winner here?
It's difficult to say, but one thing that I'm going to say for sure is that is how China perceives the situation to be. So they feel like they've been victorious. They feel like they have been vindicated. They've been telling people for a long time that the U.S. was an unreliable partner, and they feel, this is actually what is happening, and they were right in preparing to become more self-sufficient and more independent.
Amanda, I mean, Europe has also, wanted to put this critical Raw Minerals Act together, but how does it achieve that? Can it achieve that?
So Europe last year put in the Critical Raw Materials Act in order to set largely targets for critical mineral independence. It takes a lot of investment, though, to create a critical mineral supply chain, and it takes a lot of time. What China has is that they're ahead, right? So right now, all of the batteries that we produce in Europe, they come from China, right? And China can decide. Recently, European car manufacturers have had delays on their production lines because they couldn't get the permanent magnets that have the rare earths in them. And so that's recreating. It took China 20-25 years to get this dominance. We won't be able to reassert dominance until we've invested almost an equal amount, and it'll take at least 5 or 10 years to claw back some of that independence. Until then, we're dependent on Chinese supplies.
And so this also means that China, does it mean actually that China has a natural advantage when it comes to AI?
Absolutely. So their AI advantage, there's technological advantages in terms of their learning systems and all of that and what they have, but they are dependent on a lot of American-made chips, but the chips are dependent on raw materials that come from China. It's a bit of a, like, they're both kind of holding each other to ransom, and how they figure out that balance is.
But do you think it gives them a big advantage? I mean, is the ultimate race actually on what happens to AI, and is China that much more advanced?
So China is not that much more advanced. I agree with Amanda on a lot of points, but we should also bear in mind that, for example, a lot of the production of the advanced chips happens in Taiwan, not necessarily in China, or yet in the United States. The United States has an advantage in terms of design, which is why, you know, we see NVIDIA going to China and the Chinese being interested. So I do not think that China is winning the race as far as AI is concerned. They are codependent. So the question is, will they be able to decouple in some way? And that will determine who will eventually maybe win.
Thank you both for joining us, Amanda Van Dyck and Francesca Giretti, for a good conversation on China and critical minerals.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. President Trump says he's open to more trade negotiations as the EU finalizes a new retaliation list of U.S. goods if talks don't deliver a deal. NVIDIA surges pre-market on plans to resume sales of its H20 chip to China, a surprise reversal from the White House after its earlier ban. Plus, Donald Trump threatens 100% tariffs on Russia, giving Vladimir Putin 50 days to end the war in Ukraine. So U.S. President Donald Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Now, Trump said the levies would come in the form of secondary tariffs.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Well, joining us now is Greg Sullivan, our Russia economy and government editor. So, Greg, good morning. Trump ratcheting up the pressure on Russian President Vladimir Putin. What's Trump exactly been saying?
Well, there's a few things here. One, we have definitely noticed a shift towards more frustration from President Trump with Putin. He's frustrated with the intransigence from the Russian side over reaching a ceasefire in talks that so far have produced very little. He's also frustrated at the continued missiles and drone bombardments on Ukrainian cities. He made that very clear last night when he was making his announcement. And in a more concrete step, we heard that the U.S. will be continuing to supply Ukraine with some defensive armory and artillery in that announcement. So that's what we're hearing from Trump. One thing of interest, though, was amid this threat for punishment for Putin if there is no ceasefire, he also opened the door to a 50-day delay. It's unclear exactly why Trump wants this delay or what he thinks he can accomplish or if he thinks he can compel President Putin to a ceasefire in that period of time. But he has basically given Putin a time frame here to reach that ceasefire of 50 days.
So, Greg, Donald Trump also keen to emphasize that the U.S. isn't paying for weapons for Ukraine. I mean, that seems like a novelty.
Yes, it's very interesting. This is something that Trump was very focused on during his campaign. He campaigned on ending or curtailing U.S. support to Ukraine. Several in his orbit have often complained about the money being spent on Ukraine or the diminishing of U.S. stockpiles. He was very keen to make the point that Europe and NATO allies would be paying for these weapons. That does sort of raise the question of what Ukraine will get will largely depend on what Europe is willing to pay for or supply, procure. But clearly, Trump is happy with the fact that he can say that this is not the U.S. spending this money. They will sell these weapons, but it is Europe buying them and then providing them on to Ukraine, something he has long sought.
Greg, thank you so much. Greg Sullivan there, our Russia economy and government editor. Now, the UK Chancellor of the Exchequer, Rachel Reeves, will make her annual speech to London's financial industry later at Mansion House, where she's set to highlight plans to encourage home ownership. It's a key moment for the Chancellor after a painful welfare U-turn and recent market jitters over her future. Well, we're now joined by Alistair King. He's the Lord Mayor of the City of London. I have to say, with the best medallion in town. Lord Mayor, thank you so much for joining us. What exactly is on the city's wish list, actually, from Chancellor Rachel Reeves that she could announce at Mansion House tonight?
I think there are certainly a number of measures that we'd hope that she would announce. I think one is a good idea, I think, would be a reform of stamp duty to try and make sort of UK equities rather more attractive in world terms. I think we have a very high level of stamp duty, and I think we'd like to see that changed. But I think also she could do an awful lot in relation to sort of setting the tone for the city and for United Kingdom financial professional services. We've seen her doing some really good things in relation to a reform for the Financial Conduct Authority. It's been a real change in relation to what they're doing and how they're regulating and the enforcement and all the rest. And I think that's been really appreciated. I think so. A bit more of that, I think, would be very welcome.
But Lord Mayor, how important is it that she gets the messaging absolutely right for the City of London, given some of the concerns around non-dom, and that may deter investment into the country?
Yeah. I think you make a very fair point. I think that there is a potential issue in relation to non-doms, and certainly I'd be encouraging her to think about that issue. Certainly I've been discussions with government in relation to that. The thing I'd just say, though, is that having spoken to a number of big tax-related sort of advisors around the world, it wouldn't take an awful lot of a change to stop the numbers of wealthy people leaving, but also to encourage a whole tranche of others from the United States, from India, from other jurisdictions to come. So it doesn't need to be an enormous amount of change to let that happen.
Yeah, I was going to ask you, do you think these are permanent departures, or whether actually, if you think that there's not much needed to make the reversal happen, is the government listening?
Certainly in relation to my friends who've departed, all of them have done so with a very heavy heart, and goodness me, they'd like to come back. And in many cases, they haven't sold their businesses, and in some cases they've left their families here as well, even though they've expatriated themselves. So I think there is a great possibility of some of them coming back, but also to franchise so many of these others to come and join.
Lord Mayor, is there one thing that would really make a difference, actually, for the UK financial landscape to be a lot more competitive?
Well, I mean, I think that you touched on the fiscal regime in relation to personal taxation. I think that's absolutely. But I think also, I always said in relation to growth for the United Kingdom economy, if you're going to get that, the city and the financial professional services sector, that's the first place it's going to happen. The buildings are already built, the people are already trained. I think you've got this regulatory system, although it needs a bit of tweaking here and there. It's still world class. The missing ingredient is confidence. What can the Chancellor do to install confidence? And I think that's effectively my role as Lord Mayor, as the Global Ambassador for Financial, Professional, Legal and Maritime Services for the United Kingdom, is to go around the world, banging the drum, attracting foreign direct investment, but also using my size 12 boot to kick British businesses to be more, more expansive, to be more ambitious when it comes to doing things abroad. And so I think some of that from the Chancellor as well, to say, so come on, let's do things. I think that installs confidence, and that's, I think, the bit that we need.
And I know you've been a great advocate, actually, for Britons to, for example, make sure that they invest enough in their pension fund to also invest in UK assets. Yeah. Is that working? Are they listening?
Yes, I think so. Certainly we did the Mansion House Accord in May, and I think that's been well received, certainly well received around the world. But what we're trying to do is how do we make that self-sustaining? And so something we're announcing today is the employer pension pledge. We've written to the 50 largest employers in the country, and we've asked them effectively, could they make a public declaration that when they next renew their pension arrangements, could they please abide by the principles of value for money rather than pure cost? And I think that way, we go down the value for money route, effectively the possible pension outcomes are really impressive, and I think certainly better than they are currently when you have a whole load of equity trackers and all these sorts of things in pensions.
And Lord Mayor, when you talk about the Chancellor actually giving confidence, I mean, is this confidence in terms of the stability of tax regimes, or is it actually confidence in growth?
I mean, we like some stability. Businesses make better decisions when there's a stable environment there, and obviously taxes play a part, plus also general regulatory certainty. And I think it's sort of pushing in relation to our regulators for the competitiveness objective. That's something that was done 2 years ago. I think it would be good to see some real sort of solid, further solid outcomes from that competitive objective for our regulators.
When you speak to world leaders, I know you hosted President Macron in France just last week at Guildhall. What do they say about financial services? There's always, the French have always tried to attract, right, our bankers and our financial services. Is there a camaraderie on that?
I think that there's a bit of envy in relation to what London has, and goodness me, a lot of envy in that respect, because we have world-leading insurance business, world-leading legal services business. Here we have dominant position related to foreign exchange, plus excellence in asset management and also in banking. So there's a great deal of envy there. I think also, certainly what I spoke to President Macron about was saying that I think that France and the rest of Europe perhaps should think of London as a European asset. It's not just an asset for here in the United Kingdom. It's a European asset. Let's do more together.
Do you worry about big chief executives or businesses thinking of listing in the U.S.? I mean, this comes up over and over again because the U.S. could actually cut regulation, and in general is seen as having a much larger, deeper capital pool.
It's obviously a concern, and they are very fierce competitors. And so what we've been doing here in London, though, I've been just in Mansion House, using that as a convening place to bring some of the really good tech scale-up businesses that are seeking to raise between £5 and £30 million to get their Series A, Series B financing rounds, to get them up and running, because those are the companies that will be the really great sort of candidates to list on London when that moment comes. And they're much more likely to list on London if effectively the capital table is full of United Kingdom names. Sometimes in the past what's happened is that American companies have invested in the earlier stage, the Series A, Series B, and then they've inevitably gone over to the United States to list. We'd like to change that whole program.
And so, Lord Mayor, when you look at regulation here, are UK regulators, do you think they will actually pause on extra regulation until they see what's happening in the US? Because otherwise, UK businesses will be at a natural disadvantage.
Well, I think I'm not so much in the sense of pausing to wait to see the US. I think that they've got a pretty good idea as to what's needed. I think there's some stability. I think sort of a better sort of elements in relation to enforcement and other elements. Yeah, I think that the regulators are really working hard to get a better, stable environment for British financial professional services businesses to thrive.
You can't come here with beautiful diamonds and not talk to me about it. What is it? It's a medallion. I mean, it's beautiful.
It's beautiful, and also it's very useful, Francine, because I go to conferences, and although people don't necessarily recognise me, they recognise the badge, so they know exactly who I am because I'm wearing this thing, and it's hugely helpful. People come up to me, "Hello, Lord Mayor," and it's lovely to have that.
But the history, I mean, the history is again what the UK does so well.
Well, that's right, and I think the great thing is about it, though my role dates back astonishing to 1189, so 836 years. But it has a lot of history, but also it has a very modern context to be the global ambassador for United Kingdom's financial, professional, legal, and maritime services.
Just brilliant. You can come back anytime with diamonds like that.
I've been delighted. Thank you very much. I look forward to it very much.
Thank you so much, the Lord Mayor of the City of London. Now, staying with the UK, Thames Water has warned that the chances of a successful overhaul of its finances are diminishing. In a statement, the firm said there was now material uncertainty over whether a recapitalization and restructuring can be completed. The company, the UK's largest water supplier, hinted temporary nationalization may be on the cards. It says that it has enough liquidity to last for the next 12 months. Well, coming up, Wall Street's largest lenders begin reporting earnings today with JP Morgan and Citigroup first on the list. We also have an exclusive interview with the Mitsuho chief executive. That's coming up next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
The focus is on the European earnings space.
A busy week of corporate earnings.
We're going to be deeply into a lot of these earnings stories.
Bloomberg is first to break the numbers.
Santander, Caixa, Soc Gen,
Deutsche Bank, HSBC, BBVA.
A slew of bank earnings already out.
With the smartest insights.
There's an earnings revolution going on.
Markets are going to be driven more by earnings.
It looks like the worst is behind us.
Continuing coverage on Bloomberg. Context changes everything.
Well, Japan's third largest bank still sees the U.S. as a key partner despite ongoing trade and tariff uncertainty. The Mizuho Financial Group chief executive Masahiro Kihara told us how he's factoring that into his outlook for Japan's economy and bond markets.
When there is uncertainties, it's a bit hard to invest for people, right? But I don't think this uncertainty will last forever. At some point, things will be figured out, and then the world will try to adjust. The corporates will try to adjust to a new world, and that will have a lot of opportunities for both the corporates and us too. So, I am very optimistic on what's going to happen in the future.
I mean, is this new world different from what we thought it would be? So, is it different markets? Is it different trading partners?
Well, U.S. is still a very, very important partner for us. We got 100 trillion export, and among that 100 trillion, 21 trillion is to U.S. So, yeah, I mean, U.S. is still an important partner for us. But I think we will also try to diversify that. So looking to other areas is also interesting.
Are you confident in the Japanese economy overall?
Overall, I think we still have strengths in the economy sectors that we have. So I think overall, I am very confident in that. The thing is that we have to concentrate our resources in the area that we have strengths. We have high quality manufacturing, high quality products. So I think we need to figure out where the strengths are and try to sell it to the world.
Do you worry, or are there dangers actually to Japan given the spike in long-term interest rates?
Yes. So 20 years. So for the long end, especially 20 years, 30 years, there has been spike and there has been volatility. But I think the government said that they will try to shift the issuance to a 10 years or below. I think that BOJ is a little bit shrinking its QT, and I think that will help.
But is there a point where it actually starts hurting your business and starts hurting the real economy?
Well, I think BOJ is saying that the neutral rate is somewhere around 1% to 1.5%. And on top of that, 10 years will be somewhere around 2 to 2.25% then. I think that's the level that is okay. But if it goes beyond to 3% or so, that will then hurt the budget, I think.
Are you expecting more turmoil in yen, but also in the bond markets?
Not at this moment, actually. I think the current level of 1.4, 1.5 for 10 years is very. It's okay, I think. And we have. I haven't seen any turmoil in the 10-year zone. So as long as the 10-year is fine, I think it's fine.
And your thoughts on yen?
Yeah, so basically, if you think U.S. is decreasing the rates and Japan is increasing rates, the yen should get strong. Oh. Let's say somewhere around 135 level, probably.
Well, that was the Mizuho chief executive, Masahiro Kihara, speaking to me a bit earlier. Now, the European Union has finalized a list of countermeasures to target U.S. goods worth 72 billion euros, including cars, bourbon, and Boeing aircraft. Now, the measures represent the EU's response to President Trump's earlier so-called reciprocal tariffs. So we're now joined by Antonio Barroso, Bloomberg Economics senior geoeconomics analyst for Europe. And geopolitics, geoeconomics, you do everything, Antonio, because everything blurs into one. It's unclear whether it's actually trying to get money in the coffers in the U.S., whether it's political pressure because of domestic issues. So, what do we know about the EU countermeasures? And are they a deterrent, or will they use them?
Well, we know that the initial list was targeting 95 billion euros, and now it's 72, which to me shows that actually EU leaders are trying to be strategic in the sense that they want to target the US, but they don't want to hurt themselves, right? Because if you target certain goods, maybe there are problems of supply, maybe there are problems of pricing. So I think that begs the question, what can the EU do if you don't have a deal? Because, I mean, this list of goods is just targeting the reciprocal tariff that was announced on Liberation Day, right? But what happens if you have that 30% that President Donald Trump has threatened? And then I think what you're going to hear, and you're starting to hear more and more, is the EU potentially targeting U.S. services, because the EU has a deficit, a trade deficit in services. And you're going to hear about this tool called the anti-coercion instrument, which will allow the EU to actually put restrictions on U.S. companies.
Antonio, I have to say I'm confused on whether Trump sees the EU as a foe or as of a friend, because his narrative has changed quite a lot.
Yeah, I mean, but it's difficult to know. I mean, everything is possible in Donald Trump's world, and I'm not joking here. I mean, I think it really creates a lot of uncertainty because he wants to be seen in control. And when you look at how the negotiations have been unfolding, I truly believe that EU and US negotiators were negotiating in good faith. They were close to a deal, but then Trump wanted to be seen in control, and hence the letter that he sent to the European Commission President Ursula von der Leyen.
Do you see a resolution before August 1st?
As I said, anything is possible. I think it's entirely up to Trump. I think the EU was ready to accept a 10% reciprocal tariff, which, to be honest, is a one-sided sort of deal, so to speak. But they thought it would be fine to accept a 10% reciprocal tariff from the point of view of the US and maybe get some sectoral concessions. But it's entirely up to one man, Donald Trump.
Antonio, on France, I mean, we're expecting the PM to actually, try and outline a plan to narrow France's budget. Like, how can he do it?
Well, that's the big question for everybody. I think Prime Minister François Bayrou is facing crunch time because so far he hasn't had to take any difficult decisions because, he doesn't have a majority in Parliament, but France needs a budget by law. And the problem is that he's going to probably unveil around 40 billion euros in cuts, in savings, maybe through cuts and tax increases, and the opposition doesn't want to take responsibility for it. So we might well see another political crisis towards the end of the year if the opposition decides to file no confidence motions against Bayrou in Parliament.
And when you look at China, so we had GDP figures today, what's the right way for the EU to deal with China right now?
Well, what they're trying to do is trying to get the Chinese to address the concerns of Europeans, mainly what Europe considers to be the export of industrial overcapacity. And they're trying to engage by going to Beijing. Towards the end of the month, there is a summit. But actually, things are not getting better. They're getting worse in the sense that Brussels perceives that China is not doing anything to address those concerns. So I don't expect the relationship to improve. Actually, I expect the relationship to worsen.
Okay, Antonio, thanks so much for all of your insight. Antonio Barroso there, Bloomberg Economics Senior Geoeconomics Analyst for Europe. Now, officials from the European Union are to hold talks with Elon Musk's X after the company's Grok chat box caused outrage by making anti-Semitic posts last week, including praising Adolf Hitler and the Holocaust. Now, the company deleted the offending posts and apologized, blaming a faulty update. It says the recent issues were investigated and mitigated. President Trump will announce a $70 billion in artificial intelligence and energy investment in Pennsylvania later today. According to an administration official, the plan includes new data centers, power generation expansion, and grid upgrades, and as well as AI workforce training. Now, executives set to attend the launch include BlackRock's Larry Fink and the chiefs of ExxonMobil and Chevron. And Wall Street's 6 biggest banks kick off earnings this week, with JP Morgan and Citigroup set to report later this morning. Our Charlie Wells is here with a preview. Hi, Charlie. So what are analysts expecting?
Francine, there's a lot of optimism around the U.S. banking sector right now. If you take a look at this illustration of that KBW Bank Index of the major U.S. banks has been outperforming the NASDAQ 100 index so far this year. So a lot of optimism going into this, and there's reasons for this. There are expectations that some of the trading desks at these major U.S. banks should bring a boost to them. There's been a lot of volatility in the markets, and right-way wagers have been paying off for a number of these large Wall Street majors. You've got Citigroup on the fixed side really bringing leadership there. Equities, on that equities trading side, you're seeing Goldman Sachs reporting later this week. They really are bringing in a significant amount. They're expected to bring in a significant amount there. Also, if you take a look at net interest income, that is one of the most important revenue streams for a number of these banks, bringing in billions of dollars of revenue expected this quarter, and that is in this higher for longer interest rate environment that we've been in. But one of the areas where there's likely to be more of a mixed picture is on that investment banking front. We know there's been a lot of uncertainty. That's been great for these trading desks, not good for those M&A teams.
So, Charlie, are these results baked into bank share prices, which have been nearing records recently?
Francine, that is the question, and it really is sort of dividing the analyst community on Wall Street right now. We can see a lot of green on the screen so far. We see a lot there, but be careful not to read too far into this, according to some analysts who have taken a little bit more of a bearish tone here, the likes of Saul Martinez. I want to bring up some of these commentaries that show this split. Saul Martinez at HSBC talking about how a lot of this macro uncertainty actually might not be filtering into some of these share prices, levels. Now, that contrasts with the likes of the take by, say, Mike Mayo at Wells Fargo, who's basically saying as long as there's not a recession, there is a lot of room to run for these share prices. And if you want to home in from this big picture take onto a single stock, we can take a look at JP Morgan. They are reporting in just a few hours, and you can see this split. About half of analysts saying buy, according to Bloomberg consensus, and about half taking a more significant, a more conservative stance here on that front.
So Charlie, what gets in the way of banking's rally?
I mean, that's a great question, too. There are, of course, these trade tensions that we've been talking about, but there's also this split between U.S. large banks, these kind of national banks in that KBW bank index, and the regional banks. They have not been performing quite as well. And one take here from some of the more bearish voices has been that some of these big market moves that have been helping the large banks may actually be masking some trouble that is sitting in their businesses that are more in line with some of those regional banks.
Charlie, thanks so much. Charlie Wells there with the very latest on some of the bank earnings out of the U.S. Now, coming up a little bit later, the U.S. Treasury Secretary Scott Bessent joins Bloomberg Surveillance. That's at midday, London time, 7 a.m. in London. Actually, 7 a.m. in New York. It's a little bit later in London, 12 p.m. in London, so you don't want to miss that. Up next, Bloomberg Brief, and this is Bloomberg.
To the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
For Trump to have been, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging?
Yes, exactly.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. A win for chips. NVIDIA expects to gain U.S. approval to sell a model of its AI semis to China. Fighting back, the EU finalizes another list of tariff countermeasures to target U.S. goods worth over $80 billion. And bank earnings kick off. JP Morgan, Citi, Wells Fargo, all on deck alongside CPI this morning. So we got the data, we got the earnings, and ahead of that, futures hit another all-time high. We're up 1/3% and 0.5% for the NASDAQ. The reason for this outperformance is NVIDIA. Valerie Teitel will give you the details of that in just a moment. But in the meantime, for this bond market, we are a little moved this morning after a sell-off yesterday to slight gains for your 10-year yield. Yields come down about 1.5 basis points, 4.4% is where we stand. And a little bit more weakness in crude. We're trading just below $69 a barrel, down 0.4%, a bigger decline yesterday off the back of Trump threatening secondary tariffs for those that trade with Russia and Russian minerals, that really affecting oil and will have a big impact should it go through. Let's get you that NVIDIA mover along with some other stocks to watch. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Yeah, NASDAQ futures trading at record highs. It's all down to NVIDIA, up some 4.5% pre-market, as NVIDIA has been given the green light from the Trump administration to sell its H20 chip into China. This is seen as a big win for CEO Jensen Huang, who's been a vocal critic of these export restrictions. He's currently in Beijing as we speak. Let's move on to some tariff-exposed stocks from the EU's retaliation measures, said to be focused on Boeing and Kentucky Bourbon. We're seeing Boeing falling some 0.8% in pre-market trade. Brown-Forman is the owner of Jack Daniels. It was in the red, now trading unchanged this morning. And lastly, Danny, let's start on those banks that are kicking off earnings season today. JP Morgan, Wells Fargo, Citigroup, all reporting before the bell. The attention will be on their trading desk revenue. Have they captured from the volatility of the second quarter? Also, any color on their loan loss provisions, on how these banks are preparing for maybe an economic downturn in the later half of the year. Danny.
Valerie, thank you so much for that, and we'll catch up with you later in the hour. Also in this hour, we'll speak with Peter Oppenheimer of Goldman Sachs to go through an earnings preview, and we'll take a look at private markets with James Clark of Blue Owl later in the show. We also discuss the latest trade headlines with France's European Affairs Minister, Benjamin Haddad. Now, stock futures, they are gaining, trading at another record. It's a busy day of earnings and of data. In a recent note, Goldman's chief global equity strategist, Peter Oppenheimer, writes, quote, while U.S. fundamentals remain solid, the valuation premium is increasingly difficult to justify for U.S. equities and the dollar, especially as non-U.S. markets begin to show signs of relative strength and investor flows broaden. I'm pleased to say that Peter joins us now. Peter, does that mean an expectation for a melt-up this summer that you don't share those same expectations?
Morning, Danny. Look, I think the U.S. market still looks solid. The fundamentals are good. Inflation's coming down and interest rates alongside that, and we don't expect a recession. That tends to be a relatively benign environment for equities. But of course, the U.S. market is still very concentrated, driven by stocks which are fundamentally very strong, but there's less breadth there. And what we are starting to see, especially with the dollar beginning to weaken, is a growing opportunity set to diversify into other markets where valuations were a lot cheaper and the fundamentals are also improving.
Peter, the latest fund manager survey out of Bank of America showed a huge reversal in risk sentiment. Risk appetite surged by the most ever in the past 3 months. What do you make of this market that still has plenty of headwinds, from it being uncertainty about the data and whether the Fed will cut, to trade headwinds, and at the same time continued buying and continued record highs?
Yeah, in some sense it's difficult to circle because, as you say, there are some obvious headwinds around, but I think that the markets have pulled back from really worrying about recession earlier this year and a very significant shock and impact from tariffs. Now, to some degree, the fears have moderated as tariff deadlines have been passed, have been extended, and some of the worst fears about the scale of those tariffs have been pulled back. And actually, the macro data has remained solid. And I think that combination, together with the prospects of still looser monetary policy and continued economic growth, is really what's supporting equities. And we should also recognize that the broader index levels are really obscuring some very important dynamics, which is that you're getting extremely strong power in certain parts of the market in the US, particularly large cap tech again, and in other markets, pockets of value which are recovering from a very low base. Things like European banks, for example, which were even outperforming large cap tech for the first time for a long time, and that's broadening the opportunity set. But not all companies are rising to the same degree. That's why diversification is so important.
So you mentioned some of the outperformers there, Peter. Where do you want to be positioned in this environment where diversification is more important?
Well, I think that we like to see broader geographical diversification than many investors have been used to, because the US market and the US dollar have been outperforming really for 15 years now, and that's left many investors with very concentrated positions there. We like Europe and parts of Europe, particularly value and the banks, also exposure to defense and infrastructure plays as you start to get more fiscal easing in Europe. Selectively across emerging markets as well, we think the environment is relatively benign now, with the dollar beginning to weaken and US rates coming down. Many of those markets are cheap. Korea and others, for example, we think have further progress to make. But you mentioned earlier in your report banks. We think banks are in a good position. Household and private sector balance sheets remain pretty healthy. Steeper yield curves are beneficial. And of course, if you continue to get economic growth, that tends to be a good environment for the bank sector as well.
So Peter, do you understand what will be overall more important for this market to provide more fuel for the next leg higher? Is it just looking at this week alone? Is it CPI, something that confirms that the Fed will be able to start their cutting cycle, or is it strength from earnings?
Well, I think the earnings report is going to be vital. I mean, we do expect the CPI numbers to be slightly below the current consensus. I think that will help to cement confidence in a further progress towards rate cuts, particularly in the US. But actually, earnings are going to be pretty crucial. The expectations in the US for this quarter are relatively moderate, around 8% growth year over year. We think the market will be able to beat that. But I think the key is going to be in the detail. What's really happening to margins? Because margins have been holding up very well. Generally, companies have been able to be passing through higher costs and the effects of tariffs to consumers. But as the labor market weakens a bit, it's going to be really important to see whether that trend continues or whether companies are beginning to suffer from some margin squeeze. And I think that's an area of vulnerability, particularly for those companies that might start to see lower margins. So we're looking at companies with strong balance sheets, high and stable margins, both in the growth and the value space. And I think that's really the sweet spot in equities right now.
Peter, it has been really remarkable just in recent days to look at the likes of Amazon seeing the biggest ever Prime Day, to look at Delta saying that bookings for their flights are going to be improving in the second half of the year. Is this a story of consumer resilience, or is it a story of unevenness, the haves and the have-nots of some companies that are able to hold on to margins and others that will not be able to?
We're differentiating between the companies that are holding on to margins and those that aren't, I think, is a really interesting and important strategy to be following. But fundamentally, I think what we're seeing here is that the consumer generally is still holding up quite well. Broadly, in most countries, unemployment is low. Household balance sheets are pretty good, particularly outside of the US, but even in the US. And of course, there is a differential across the income distribution. But overall, that resilience, I think, is relatively healthy, particularly as we go into a period of lower interest rates. And we've long believed that we wouldn't see a recession in this cycle. But it is really important to emphasize, I think, that private sector balance sheets, households, but also importantly, corporates and banks are relatively strong compared to many other periods that we've seen. And that resilience, I think, is an important underlying support for risk assets and indeed for economic prospects more broadly.
Peter, we're going to have to leave it there. Thank you so much for your thoughts and your time this morning. Peter Oppenheimer of Goldman Sachs. By the way, those CPI figures come in 3.5 hours. Time expectation is for 0.3% month over month for both headline and core. Let's get you now some other top stories that are trending on the terminal this morning. The EU has finalized a second list of countermeasures targeting $84 billion worth of U.S. goods if it decides to retaliate against President Trump's tariff policy. That list includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to more negotiations on trade after announcing a 30% levy on EU imports. Elsewhere, President Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Trump said the levies would come in the form of, quote, secondary tariffs without giving details.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
And the FT reporting moments ago on that President Trump has privately encouraged Ukraine to step up its deep strikes on Russian territory. Elsewhere, in China, the economy grew more than expected in the second quarter, driven by strong exports to markets outside the U.S. The data, though, also showed weak consumer demand at home. GDP expanded 5.2% year on year. Coming up, NVIDIA says it can sell its H20 chips to China again. Shares get a boost. More on that next.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB forum in Central Portugal, and this is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Chinese competitors have evolved and advanced greatly over the last year. One of the challenges of the changing regulations is the ability for markets to trust the NVIDIA and ultimately American platforms. It's prudent, I think, for the Chinese customers to make sure that they develop their stack on Huawei, and because it's hard to rely on American technology at this point.
NVIDIA CEO Jensen Huang speaking with Bloomberg a few weeks ago in May, talking about the difficulties of preventative regulation of selling their chips into China. And NVIDIA shares are rising, up nearly 5% in the pre-market. NVIDIA now said it expects sales of its H20 AI chips to China to resume. For more, Bloomberg tech editor Mark Bergen joins us. Mark, do we understand why the reversal from U.S. regulators?
U.S. officials have not commented yet. I mean, I think their best assumption here is that Huang and NVIDIA have been arguing, China is developing AI, whether the U.S. likes it or not. And the argument from NVIDIA is why not have it be built on U.S. technology where we have the control. And he said this is basically, he's called the U.S. chips policy a failure before, pretty strong language. I think that's an effective, it seems like that argument's won here, where it's saying we'll be able to control the allocation of these chips, and they're built on NVIDIA and not on Huawei and Chinese technology.
What does it mean for NVIDIA? As I said, the shares are rallying this morning. Mark, just how big of a win is it for the company?
Yeah, it's huge. I mean, I think that they put the number about $5 billion as this what they kind of allocated for sales in China, because they're the H20 chips that they're specially designed for the Chinese market, that they basically said they were unusable given this policy. Now you have this big boom. We're seeing this explosion after DeepSeek, large giants in China like Alibaba, as well as this new wave of startups, DeepSeek, Manus, that are really rapidly advancing these AI models that are incredibly compute intensive, that need the GPUs that only NVIDIA and Huawei at this point, and AMD, a few handful of companies provide.
Though, if the narrative had been from Jensen Huang, Mark, that China was advancing and that U.S. companies like NVIDIA needed to be in there to arrest that advance, is it too little too late? Does China tech continue to advance and try to find replacements, even though NVIDIA is back for now?
That's a good question. I mean, I think that there's a lot of lock-in. NVIDIA's clearly shown that it's not just its hardware, but it has it's pretty advanced software that companies, once they're using the chips from NVIDIA, it's really hard to switch. It's really intensive and requires a lot of effort. It might be the same with Huawei, right? Once you're locked into Huawei, why switch to NVIDIA? But I think clearly what we've seen demonstrated is that DeepSeek has said what little they've communicated is we wish we had a lot more NVIDIA chips. And so the assumption there is that these companies that are developing AI models out of China are most likely going to buy as many GPUs as they can.
Mark, is this also just a win for Jensen Huang, the diplomat?
I would say so. I mean, I think he's up there with Tim Cook as far as tech CEOs as diplomats. This is a $4 trillion company that seems to have extremely influential political power.
All right, Mark, thank you very much. That is Bloomberg's Mark Bergen. And NVIDIA lifting all boats this morning. It is an S&P 500 future session that is yet again trading at a record. The NASDAQ up 0.5%. We are seeing some dollar weakness while U.S. yields come down about 2 basis points. Okay, coming up, Wall Street earnings kick off. JP Morgan, Citi, Wells Fargo, all of the companies on deck will have what you need to watch for those results when they hit the tape. That's coming up next on your Bloomberg Brief.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
You are watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news and see what the major publications are running with this morning. The New York Times leads with a win for President Trump. The Supreme Court has cleared the way for the president's cuts to the Education Department, which expands his executive power. Justices lifted a federal judge's order that reinstated nearly 1,400 workers affected by mass firings. A legal challenge continues, though, to play out in the lower courts. Now, a Washington Post exclusive, ICE has declared millions of undocumented immigrants ineligible for bond hearings. The agency issued a memo instructing officers to hold undocumented immigrants for the duration of the removal proceedings. The policy applies to millions who cross the U.S.-Mexico border over the past few decades. And on the FT, catastrophe bond sales hit a record as insurers offload climate risks. Issuance of cat bonds, which transfer part of the risk for disasters to bondholders, has surged to over $18 billion so far this year. Insurers have had to pay out more than $100 billion in natural catastrophe losses every year so far this decade. And Wall Street's biggest banks kick off the earnings season with JP Morgan, Citi, and Wells set to report just this morning. Bloomberg's Charlie Wells joins us for a preview. Charlie, what you looking out for?
Danny, so it's big and there's a lot of high stakes here because the share prices of these banks have been getting close to records. That KBW Bank Index really zooming north from that downturn in the April period. And so there's a lot of pressure here and there's some, positive expectations here, particularly on that trading side. We've seen a lot of volatility in the markets and some right-way bets are expected at least to have gone well for a number of these banks. Citigroup on the fixed side is expected to bring in a lot of leadership on that front as far as those league tables go. And then on the equities trading side, Goldman Sachs there, also net interest income, as we're seeing, the potential to bring in billions of dollars for these banks in this higher for longer rate environment. It's going to be a little bit more of a mixed picture on that investment banking front, where we've seen, some banks have strength, but this uncertainty creating more of a negative environment for that M&A activity.
Even so, Charlie, we're looking at bank share prices, many of which have been nearing records recently. How much is already baked into it?
I mean, Danny, that is really a question that's sort of dividing analysts on Wall Street right now. So in some corners, the Mike Mayos at Wells Fargo of the world, they've got a very bullish take. They see a fundamental shift, at least a generational shift in the way that banking works in the United States right now. And they see a lot of room to run for these shares that have already been approaching records, as I mentioned. But if you think about Saul Martinez at HSBC, he put out some commentary recently talking about how a lot of the uncertainty that's out there in the markets is not necessarily being priced into these shares. And we're looking at JP Morgan. We're looking at analyst ratings here right now. JP Morgan reporting later this morning. About half of analysts give that a buy rating, but others take a more cautious stance here. So, that really is speaking to the split in the analyst community, at least at this point.
What is sort of the split to the downside, Charlie? What are the expectations that could get in the way for these banking shares?
They're all out there looming in the economy. No one's exactly sure what this could be, what could cut into this rally. But look, we've got these trade tensions, we've got these negotiations. If those do not go the way that analysts are expecting, that could hurt bank earnings going forward. Again, also, we have this regional divide between sort of the more regional banks and some of these Wall Street majors. And, one take here is that some of these regional banks not faring quite as well in the markets, they could be exposed to the sorts of, consumer issues, some of the real estate issues that would also face these larger banks, but that these issues might just be masked by some of this Wall Street strength that we're seeing. So that could be hiding in plain sight. So that's a framework to view these earnings through as they report later today and throughout the week.
Yeah, and everyone also wants to know what the weather forecast is from Jamie Dimon. Most recently, he talked about markets being complacent and underappreciating some of the trade risks. We'll see whether he sounds the same on today's earnings call. Again, that is Bloomberg's Charlie Wells. Thank you so much for your reporting this morning. JP Morgan, Citi, Wells Fargo, all on deck. In the meantime, we are looking at something of a bond market rally. A lot going on in the world of finance. We're expecting both budgets for the UK and France to be unveiled. There has been a lot of tension. Governments around the world, most recently Japan, over fears of their spending. The U.S. bonds, those are down by about 2 basis points this morning at 4.4%. Meanwhile, in the world of FX, you continue to look at a weaker dollar this morning, while the euro trades at 116, sterling at 134. Coming up, we look at private credit and the expansion into retail. We're going to talk with James Clark of Blue Owl after their announcement about 401ks and a partnership there. That's next. This is Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. A win for chips. NVIDIA expects to gain U.S. approval to sell a model of its AI semis to China. Fighting back, the EU finalizes another list of tariff countermeasures to target U.S. goods worth over $80 billion. And bank earnings kick off. JP Morgan, Citi, Wells Fargo, all on deck alongside CPI data this morning. So yes, it is CPI day and the unofficial start to U.S. earnings season, and we start with another record high on both the S&P and NASDAQ futures, NASDAQ being led by NVIDIA this morning after the resumption of their exports of H20 chips. We also got the latest Bank of America Fund Manager survey. Risk appetite surged by the most ever in the past 3 months. Bonds, they are little changed this morning, especially on the front end after a sell-off yesterday. That starts to ease, though, with yields down about 2 basis points for the 10-year. We're at 441. Brent crude switches from losses to gains this morning after a more than 1% decline after President Trump threatened 100% secondary tariffs on buyers of Russian minerals if a ceasefire deal with Ukraine isn't reached. Let's look at some stocks under the surface. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start in the tech space with those NASDAQ futures hovering at record highs. It's all down to NVIDIA gaining some 5.1% after NVIDIA is expected to get those export licenses for their H20 chip to sell into China, seen as a very big win for the CEO, Jensen Huang, who's been a vocal critic on these export licenses. He was in the White House last week, and now he's in Beijing to maybe celebrate this win. Let's stay in this tech sector and talk about Apple making a new investment in a rare earth company. This is MP Materials, up 11.5%. This is a report from Fox News that Apple is set to invest $500 million in this company to get their access to rare earths that they produce here in the U.S. Let's stay in the tech sector. Let's move on to CoreWeave. We do have some breaking news that they have invested in some data centers. We're seeing those shares up 5.6%, but you're seeing the theme here, Danny. We are seeing these AI-related stocks invest more in AI and get a win on chip export licenses. It seems like a great day for those tech stocks.
It does. Meta similarly talking about a new data center. Val, thank you so much. Now, elsewhere, your 401k may be getting an update. Blue Owl Capital and Voya Financial have signed a pact to develop private market investment products for defined contribution retirement plans, a push that many private credit players are making as the industry balloons and grows more popular. I'm pleased to say joining us now is a man that's helping make that investment more popular. It is James Clark, Global Head of Institutional Capital of Blue Owl, who is on a world tour in the Middle East. James, really wonderful to see you this morning. Let's start there on your world tour. You're speaking to us from Dubai. Why the Middle East? What is your ambitions? What are Blue Owl's ambitions of growth there?
Danny, great to see you. Look, the Middle East has been an area of focus for us going back a long period of time here. We've been very fortunate to acquire a number of partnerships that have been integral to our growth. That continues to expand. And why now? We have to be here 24/7 and focused. This is an area of the market to come regularly and often. It's not just when it suits us. It's to be here 24/7 and focused. So this brings me here. But just to be clear, it's not an area that I episodically showed up in at this particular point in time. It's been a long time coming, and we've been very fortunate to build those partnerships.
Just on that, because it is this period of uncertainty, James. You feel it in the daily headlines of unknowingness of where rates go, of where trade headlines go. Does that uncertainty crop up in your conversations with LPs? How are they digesting and making those decisions to allocate capital when there does seem to be this fog around the world right now?
Look, these fogs have always persisted. I mean, if you just think about growth over the last century, I mean, for example, you had progressivism in the 1920s, you were coming out of the Great War, you had World War II, you had the New Deal, that kind of like stymied things there, and obviously in the 1960s with the Great Society in Vietnam. So these conflicts are always happening. And I think what's important to our investors, which is super important to the mandate that we fulfill, is to withstand those geopolitical shocks. Remember, we're private market investors. We're making investments for the long term. We're not fixated on the near and present. We can't be agnostic towards it. We do need to think about the implications of this, but the most important thing is we're making long-term investments, long-duration investments that can withstand these cyclical bumps.
Can we talk about one form of that long-term investment, James? I know you are there speaking to institutional clients as you are the head of institutional capital, but it is a Blue Owl that, as of yesterday, seems to be pushing more into retail with the announcement of a partnership with Voya Capital into 401ks. What's the thinking behind that? Why push more? You already have a very strong wealth presence. Why push more into very retail-oriented type exposures?
Yeah, you're right, Danny. We have been a long-term player in the wealth space. In fact, I think that was inked in our DNA from the very start, and we've developed a dominance there. Look, what you're seeing is the democratization of alternative assets. Individual investors, just like institutions, they want to see a full palette of investment options. They can't just be, I guess, sort of handicapped by being in traditional public market asset classes. Very sort of similar to your question that you mentioned before about why people continue to invest in alternatives to withstand those shocks. They want to be exposed to that too. So this has been an integral partnership for us. It's one that, in fact, we think we can take to a broader remit of individual investors. And I think that the replication of what we've seen in the alternative space will continue. It's a very exciting development for us.
One of the often hesitations from adopting private capital into these retail 401k type products are just high fees.
Yeah.
James, if fees end up coming down for retail, does that mean that we are going to enter a cycle where fees more generally for private credit, for private capital, need to and start to reduce?
Look, while fees may potentially come down, and I use the word potentially and I underscore it because remember, our investors are looking at absolute returns. They're looking for preservation of capital. They're looking for income. They're willing to sort of withstand that trade-off, if you will. But remember, there's economies of scale here for large institutional investors. So yes, while the fees, and again, I underscore the word potentially may come down, what's super important is understand that the amount of available capital in the alternative space has only increased. I can speak to that myself personally. We have a number of large institutional investors that have significantly increased their exposure to alternatives because they've looked at other asset classes and they want to identify that asymmetric risk, and they're not necessarily just fixated on capturing the beta of the market. They want exposure that can withstand those cyclical shocks. So yeah, back to your question, fees, look, are always a discussion. And when we go into partnership with people, that is something that we pay a lot of attention for. But just remember the scale of these mandates to increase. We've discussed this before, but scale is our friend. To support the types of investments we want to do, we need that capital, and our partners need to have that exposure. So there's this symbiotic relationship that is integral to both us and them achieving their objectives.
As you're going around having these conversations, James, one thing that's really changed in the world is a willingness to spend on defense. We heard it from France over the weekend that they would be spending more on their defense capabilities. It's an industry that typically private credit has shied away from, but as there is more demand, would Blue Owl, is this an industry that perhaps needs to take a second look at funding things like defense companies?
Yeah, look, you're always taking a look at all the available sectors out there. What I am going to tell you is that there are, again, these areas where on, off, particularly around macro issues, that can potentially guide investment decisions for the short term, not the long term. Look, we always keep an open posture to things, but if you think about the way we operate, that's not a lane we're in. We really want to focus away from the non-cyclical. And I would say there is a degree of embedded cyclicality in that. Who knows what administrations are going to do? Who knows who's going to be the next prime minister or president of a specific nation? The most important thing is to stick to what your remit is, what you're focused on. So if you actually look across where we traffic, as I've said before, it really is in those cyclical or non-cyclical, should I say, sectors. That's super important to us. These are long duration investments. I don't know who's going to be president in the next 4 years. It's open for conjecture. We can all debate that. But I do think that what I do know is that the businesses we'll invest in are built to last.
James, I think you'll be relieved to know that I will not drag you into that debate. I will leave that one just sitting out there.
I am so grateful, Danny. I'm so grateful for that. Thank you. It never ends up well. There are two things to stay away from in a conversation, and that's one of them.
All right. I don't think I'll ask you what the second one is either. I think I'll give you relief there, James. Thank you so much for joining. It is always a pleasure to speak with you. Please come join again soon. James Clark, Blue Owl's Global Head of Institutional Capital. Okay, coming up, the EU strikes back. Boeing, cars, and bourbon are on the latest list of EU countermeasures and ongoing trade war with the U.S. We'll hear from France's Europe Affairs Minister, Benjamin Haddad. That's coming up next on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The deals are already made. The letters are the deals. The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk.
President Trump there yesterday saying that he remains open to talks, but the EU is signaling that it's open to retaliate. The bloc has finalized a list of U.S. goods worth over $80 billion to target, if it so chooses, to counter against Washington's tariffs. Among those, Boeing jets, bourbon, and U.S. autos. For more, let's bring in Bloomberg's Brendan Murray, who tracks global trade. Brendan, what did we learn about how the EU might strike back?
Well, the European Union, up until a couple of days ago, thought it was heading closer to a deal with Trump. But as he's indicated over the weekend and in his comments from yesterday, is you never really know if a deal is going to come together with him until it's actually done. So what the Europeans are doing is preparing a list of products, of U.S. products that they will target with tariffs of their own in a commensurate way as they feel like they would be hit. So the message being sent really from Brussels is that they need to show Donald Trump that they will stand up to the tariffs that he will impose on European goods come August 1st, and to see if they can still negotiate over the next 2.5 weeks some sort of deal that prevents a transatlantic trade war.
Brendan, the clock is ticking down. Thank you very much. That is Bloomberg's Brendan Murray. And let's stay on those trade tensions between the U.S. and EU. I'm pleased to say that joining us now is France's Minister for Europe Affairs, Benjamin Haddad. Minister, thank you so much for joining this morning. And look, that announcement of a 30% tariff for the EU come August 1st. It comes after just the week prior, the EU said it was close to a deal. How much does the weekend's announcements change things for negotiations between the EU and the US?
Hi, thanks for having me. Look, let's be honest. These tariff threats are unjustified and unacceptable. And we have a strong trade relationship between both sides of the Atlantic. They've underpinned our shared prosperity for the last 75 years. And Europeans, and the Commission was quite clear about this, will defend their interest with determination and resolve. We want a good trade relationship with the United States. We want a deal that de-escalates, that's mutually beneficial. The Europeans have been very clear about this in the negotiation with the administration over the last couple months. But it is clear that we have the tools and instruments to retaliate. The Commission has already announced, as you saw, countermeasures on goods that would amount to close to 100 billion euros in trade. That's based basically on the measures that we had implemented under the first Trump administration at the time. But we can go further. We can go further with instruments that the EU has developed over the last few years. I'm thinking, for example, of the anti-coercion mechanism, which would allow to broaden the scopes to services, to technological services, by taxing U.S. tech companies, by bearing access to public tenders. Once again, you know, the European Union is a vast unified bloc. It's a major trading partner to the United States. We want to continue to have a good trading relationship, but we have the tools, we have the means to defend our interest, and we will do so.
Those tools, the escalation of which, Minister, should tariffs go on as 30% in August 1st, is that enough to implement the tools at which you've talked about just there?
It's pretty clear, to answer your question, that the Commission has already signaled that if we are in a situation that's asymmetric, where we have tariffs that are unjustified, that's imposed on the European economy, then there will be a response from the European Commission.
Trump, though, did insist that the recent letters are the deals. He said, quote, "There are no deals to make." Is it your assumption, though, that the letter over the weekend, that it was just a negotiating tactic, that it was escalate to de-escalate, and the rate will come down by the deadline in 2.5 weeks' time?
You know, it's not my role to speculate on what the administration wants to do. We've been very clear, once again, that the Europeans want to trade with the United States. They want to come to a deal that's mutually beneficial. They want to continue the relationship that, you know, once again, has been at the center of the prosperity and the growth of both sides of the Atlantic ever since we set up a trade system that's non-discriminatory, that's based on free trade, on access, on so many of the products that we're discussing today. But once again, it is clear that the European Union will defend itself. We've actually strengthened our instruments over the last few years. I was mentioning the anti-coercion instrument. This is something that did not exist a few years ago. And then when you look at the trade pressure that the EU has been under from different sides of the world, then we've decided to have these tools to be able to react. And so the Commission now has made clear that you have these countermeasures that are being discussed that can be implemented if we don't find an agreement. And once again, you know, in this negotiation, you need to show strength, you need to show force, unity, and resolve, and this is what Europeans will have.
Are you sure that there is unity, Minister? There has been some difference in tones, for example, from President Macron and President Merz, Chancellor Merz, rather, in terms of whether the idea is to show strength or any deal is better than no deal. Is there really that unity, or are there fears of some fractures between what heads of countries are really willing to accept from the U.S.?
You know, as you may see, maybe from the Brandenburg Gate just behind me, I'm in Berlin. And we speak to our German friends on a daily basis because we have such a strong unified agenda on this and all the rest. When you think about stepping up our defense spending and rearming Europe, when you think about investing massively into tech, into the competitiveness of the European Union, because this is also one other way to react to the pressure that we're under, is making sure that we really support our ecosystem of innovation, our entrepreneurs, our companies in this world competition. And of course, we do this with our German friends. And you know, we've been very clear with Chancellor Merz that we want to find a deal. We want to de-escalate. That's been the objective of both France and Germany, but as well. But the question is, how do we negotiate and how do we show this resolve to our U.S. counterpart? And I think the tone coming from the European Commission saying, for example, that it's ready to implement the countermeasure is very important, precisely to stress that point.
Minister, you mentioned some of the increase in defense spending, but for France, it also comes at a time when both taxes and the deficit are high. How does France cover the cost without incurring a significant expansion of the budget deficit and at the same time really increasing and expanding the defense capabilities of the country?
You know, President Macron on Sunday made a very important speech about military spending and more broadly about the threat situation that we're facing. We have the war of Russian aggression at our border against Ukraine, but more generally, the threat that Russia is posing to all of our democracies. We have, of course, the US that is signaling that it wants to focus on Asia, that it wants also Europeans to step up and take more ownership for their defense. This calls on us to bear more burden for our own security and defense. Over the 2 terms of the Macron presidency, we'll have doubled the defense budget of France. We'll need to continue to do so. It's a generational effort, and we also need to continue to do it at the European level to really have a strong European defense industrial base. This needs resources, and this is why President Macron took the initiative to call for the increase of defense spending by about 3 billion euros for this year and for the year after. And you're right, this comes at the time where we also need to make responsible choices for our budget. The Prime Minister will unveil the new budget, and we'll have a sequence of negotiation with the different groups in parliaments. We need to cut on public spending. We need to bring down the debt and deficit. And we also need to continue to reform our system. Over the last 8 years, the 2 terms of the Macron presidency, we reformed our system, and this is why France became the most attractive country for foreign investments in Europe. This is why we brought down unemployment to historic lows. You know, for a long time we said that we were condemned to high unemployment. We've brought it to historic lows. This is also a way to continue to bring in fiscal income. So we'll have to bring down our spending. We'll have to continue to invest and reform, and we'll have to invest in defense, because this is really about the sovereignty and security of Europeans.
Minister, we really appreciate your time this morning. Unfortunately, coming up against a commercial break, we thank you so much. French European Affairs Minister Benjamin Haddad. You're watching Bloomberg Brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask
interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day. JP Morgan will be kicking off U.S. bank earnings before the bell, followed by Wells Fargo and Citi. CPI then at 8:30 a.m. Eastern. And President Trump expected to deliver remarks at the inaugural Pennsylvania Energy and Innovation Summit in Pittsburgh at 3:30 p.m. Some individual stocks moving this morning. NVIDIA, that leading the entire market higher by 5%, said that it will be resuming its sales of H20 chips to China. Also dropping moments ago, ByteDance and Tencent are in process to apply for NVIDIA chips, according to Reuters. CoreWeave up 8%, set to unveil $1 billion investment into data infrastructure, and MP Materials. Those shares up also another chunky amount, up 11.8%. A report from Fox Business of a $500 million investment from Apple. All right, that is it for your Bloomberg Brief this morning. Surveillance takes it from here on Bank and CPI Day.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The tariffs could definitely create some inflationary headwinds.
The effects of the tariffs are actually going to take some time.
We will not start seeing the inflation effects until a few more months down the road.
It's still too early for us to really start to see a wave of inflation.
The risk to us is that we see a more persistent impact of inflation.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, earnings season begins. This hour, JP Morgan's Jamie Dimon kicking off earnings season on Wall Street as investors look for any signs that trade policy is fueling higher consumer prices. The president is calling for the Federal Reserve to drop interest rates to 1%. A big morning coming up.
The reason why this morning is so important is because people have been looking for concrete evidence of what the ramification for tariffs will be. Will we get it? Remains to be seen. That said, we've got the 1-2 punch. First, you get the corporate earnings from the big banks. You can make an argument, okay, corporate earnings, very important. However, are banks representative of the rest of corporate America? If you are concerned about that, you can move on to the CPI report that we get on 8:30. And do you see the inflationary impacts from tariffs really hitting consumers?
3 months ago, Jamie Dimon said this. Maybe when we do this call next quarter, we won't be guessing. 3 months later, feels like we're still guessing.
Well, we're still guessing because we do not have the deals that the administration promised. And what they've done is move the timeline out. So now everyone is talking about August 1st. Can they get all these deals done in the next 2.5 weeks? Jamie Dimon also last week said, unfortunately, I think there's complacency in the markets in reaction to tariff news. One thing we did learn since Liberation Day on April 2nd is that there was this idea of the Trump put. So the markets do think that what Trump sees, reaction in the market, whether it's the bond market or the equity market, pushing back on his policy, that he will reverse course. And that is why when he comes out with some of these new sky-high numbers that mirror April 2nd, the market shrugged it off.
The support this morning is coming from one single name. Check out NVIDIA. NVIDIA in the pre-market higher by 5%. This statement from this company. Filing applications to sell the NVIDIA H20 GPU again into China, the U.S. government has assured NVIDIA that licenses will be granted.
This is a dramatic reversal from this administration. We need to remember this chip was designed when Biden was in power, and they were trying to make sure they could have a chip that would be compliant with export controls under the Biden administration. So they came up with this H20. And then in April, because of national security concerns, the Trump administration says you can no longer send that chip to China. And now what we've seen after a meeting with the president, and Jensen Huang right now is in Beijing, a reversal, and NVIDIA is saying that they have these assurances that they can start sending that chip once again to China.
This is emblematic of 2025 and of the whipsaw that we have seen, both in expectations for tariffs, in expectations for sectors, in expectation for bifurcations, and then not for bifurcations within the tech sector globally. If you look at stock investors' exposure to equities that are attached to tech companies, they have increased the most over the past 3 months since March 2009. This according to the Bank of America Fund Manager Survey, and it just shows how this flipping and this flopping is reflected in some of the positioning.
Things are getting toppy, according to that fund manager survey. Check this out, the biggest surge in profit optimism since July 2020. Cash levels falling to 3.9% across the board here. That is one heck of a bullish survey from Bank of America this morning.
Conditioned by experience, how many times have corporations set the bar incredibly low and then just leaped over them and shown how well they're able to really handle this? We heard from Delta, things are stable. If you hear that from the rest of corporate America, people are more concerned about getting in than they are about some sort of risk-off move. Even that Bank of America survey that was signaling sell in certain parts, they're not saying sell. They're just saying rotate, because ultimately it has been a fool's errand to try to time this market or bet against it.
Futures this morning doing better, up 1/3% on the S&P 500. Coming up this hour, Cameron Dawson of New Edge Wealth ahead of this morning's inflation data. Michael Froman of the Council on Foreign Relations as Europe prepares to retaliate, and Gerard Cassidy of RBC as JP Morgan kicks off bank earnings. We begin this hour with stocks rising as investors await bank earnings and the latest read on inflation. Cameron Dawson of New Edge Wealth writing the following. Investors are feasting on a buffet of reasons to look through tariff headlines. There are reasons to see this as rational, but also reasons to see this as complacent and risky. Cameron joins us now for more. Cameron, good morning.
Good morning.
Got to pick one, I'm afraid. What is it? Complacent or rational?
So we think that the reasons for rationality make sense in the short term, because certainly we've seen the track record of Trump over the course of the last couple of months really using tariffs as a negotiating tool and saying that that's not policy destiny. And you've seen very little impact to the data or earnings from tariffs. But we're not sure if that sticks. We do know about Trump that he likes tariffs, and the more that markets rally, the more that he's emboldened to stick with these higher tariff rates. And on the data front, we simply think it's going to take time for this to show itself in the data, whether we're thinking about inflation, growth data, and really on earnings. Earnings, we have the dynamic of a big inventory pull forward, things like FIFO accounting going back to CFA level 1. That dynamic means that we're simply not seeing it pass through to company earnings yet, and it might be more of a third quarter dynamic versus something that we're going to experience this week.
Something for everyone this morning. In about 40 minutes time, numbers from JP Morgan. Later on this morning at 8:30, CPI data. If you had to pick one this morning, what are you more focused on, the earnings or the data?
I'm more interested in the reaction to the earnings, not necessarily the earnings themselves. I think that it is very much consensus that we're going to get beats and raises. After all, the average is 80% of companies do beat on earnings, and expectations are pretty high on a buy-side whisper number that you're going to see beats and raises. I think the bigger surprise could come on the CPI side of things. And this is where we could see a dynamic where the overall CPI stays somewhat healthy or muted, but underneath the surface, we start to see evidence of the tariffs start to come through in the goods line of things. So overall CPI dampened by things like shelter inflation coming down, but then you see that evidence of tariffs working its way through the goods side of things, and it's a question of what does the Fed do with that?
Which really points me toward what the market's done with this since the last CPI print that we got on June 11th. You can see that yields are basically the same place. People are pricing in a lot of the same in the bond market. It's been incredibly stable, and yet the stock market is up 4%. What's changed since the last CPI report?
Yeah. Other than that, positioning continues to chase higher. We think that that has been the key driver of the market rally and the reason why equities have been able to defy all odds and continue to make new highs. But as you're starting to see with that B of A fund manager survey, you're starting to see in the Deutsche Bank consolidated positioning that positioning is no longer underweight, sentiment is no longer bearish. We're now in a bullish position. Positioning looks to be somewhat neutral. So maybe not at the point yet where it is an outright headwind, but certainly less of a tailwind than it has been.
How representative are the big banks of corporate America? How much do they actually set a tone at a time where they're increasingly dancing to their own music?
Yeah, I think that there's a certain microcosm. Of course, they touch all the industries in the U.S., and so if we were thinking that there was going to be an economic downturn, these are, after all, very cyclically oriented companies. So if the economy was truly rolling over, banks would not be at a new all-time high. So this is a cyclical endorsement to see banks trading so strong, but there's a lot of idiosyncratic things going on with banks. There's questions about regulatory relief and capital relief. You also have questions about if we see an M&A, an IPO defrosting, that could certainly boost earnings. I think the thing to watch with banks is you're trading at 1.5 times book. That is the high end of the range that banks have traded at in the post-Great Financial Crisis period. So either valuations are hitting a ceiling or we are going into some brand new paradigm where you're seeing valuations be able to trade much higher than that.
The concern is tariff uncertainty even for banks, but at the same time, tariffs have created volatility, have created a tremendous amount of opportunity for these banks. Aren't they going to ink a ton of money this quarter?
Well, certainly, I think the expectation is that you are going to see big beats and raises, and the estimates are fairly low on the sell side. It's just for low single-digit type of growth. I think it all comes back to on the tariff side of things is that $100 billion of tariff revenue have been raised. That's a run rate of over $300 billion for the year. The question is, who is paying it? We don't know. We do know the evidence so far is that it's not exporters. Otherwise, you would see it in import prices. So there is somebody in this economy that is paying for that $100 billion in tariffs. We think it is effectively within corporate margins. You're not seeing as much of a pass-through yet to the end consumer, but companies have the ability to block and tackle and kind of push out some of those cost dynamics and not necessarily see it in earnings this quarter.
How hard is it to unwind the actual impact of tariffs when Trump has not finalized the final rates?
Well, it's certainly uncertain. And I think that that's one of the reasons why this market is just so willing to look through it. For lack of evidence, why price it in? And so there is this expectation that maybe you will see some headwind, but by the time you get to the point that you're actually seeing it in the numbers, we'll move on to the next issue. But that's where we think that there is a certain degree of complacency, simply because estimates are for a big acceleration in earnings in 2026 as well to low double digits.
We've had something like four soft than expected CPI reads in this country over the previous 4 months. Can we make it 5 at 8:30 Eastern time?
The range of estimates for economists goes from 0.1% month over month to 0.4% month over month. So it gives you a sense of, we don't know. How many ways can you say, we have no clue which way this is going? Okay, got it. And that's sort of where we're at right now.
Even if it's softer, we've got a bunch of people still saying we're working through pre-tariff inventory, and this is noise, not signal.
And it's being absorbed by the fact that you've got pre-written contracts with certain pricing put in there. So how do you understand when we have some sort of final read on the ramifications from tariffs that haven't been inked yet? And this is sort of the certainty people are looking for. Well, good luck, because hopefully we'll get some, but, I wouldn't hold my breath.
Chairman Powell's in a tough spot. Does he just keep waiting?
We think that that's the best move. Until the employment data shows some sign of weakness, we think that they do wait, that the uncertainty about the future path of inflation keeps them in a holding pattern. Because if you don't see inflation this month, it may be coming in July. And if you see this resilience in the labor market, and I would add to that resilience within overall assets, financial conditions are still in very easy levels. This is not an equity market or a credit market that is screaming at you to cut interest rates immediately because it needs help.
Cameron Dawson of New Edge Wealth. Good to see you. Thank you, Cam. Appreciate it. Your guidebook for this morning, in about 35 minutes' time, we should get some numbers from JP Morgan, expecting that at about 6:45 Eastern. Later on after that, the data, 8:30 Eastern time. In between, this conversation right here, 7 a.m. Eastern time, the Treasury Secretary, Scott Bessent, live and exclusive on Bloomberg Surveillance.
It's going to be an interesting conversation, of course, given the fact we have a lot of economic data, earnings coming out, and this is the man who is in charge of these trade negotiations, and he's headed off at the end of this week to Japan. This is a country that, out of the gates, they thought they were going to be able to ink a deal. They aren't. They have an election coming up the end of July 20th, around the corner. Potentially, he's going there to potentially see if they could get this deal over the finish line.
Is it Kevin, and Scott? That's my question.
What about Chris?
Yeah, Kevin, Chris, and Scott. But, in terms of the Kevins, Chris, and Scott, because I was looking at the Bank of America Merrill Lynch survey, and they actually think that Scott, a plurality of all people, think that Scott's the front runner. He's going to say, I know what he's going to say. It's going to be, I'm focused on the job that I have at hand, et cetera, et cetera. But still, how does it complicate things that his name keeps getting bandied about when he's in charge of selecting somebody?
I think the issue the president would have with, even if he really wanted Bessent to go down the block and go to the Fed, and the other day when Trump was talking about Powell, he looked at Scott in the cabinet room and said, I like you better. Of course he likes him better, but can you imagine that hole that they would have to fill at the Treasury Department? This is the individual that's leading the talks when it comes to China. No one thinks that China's trade deal talks are going to be done by the end of the year. It'd be a massive hole to fill for this administration.
I'm sure he's loving it. Wouldn't you love it? Your name's associated with being the Fed chair, you're the Treasury Secretary.
Everyone calls you the
this
one
is
sane
terrible.
person.
Oh, this is so difficult to deal with.
I can't handle it.
Awful.
Terrible. I can't believe how loved I am.
Futures positive this morning by 0.4% on the S&P. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara Arnott. Hey, Yahara.
Good morning, John. We start with the check on NVIDIA. Shares are up nearly 5% in the pre-market. The company said it would resume sales of its H20 chip in China after the Trump administration reversed earlier restrictions aimed at limiting Beijing's AI ambitions. The move could add billions to NVIDIA's revenue, restoring its ability to fulfill orders it had written off as lost due to those restrictions. Meanwhile, the European Union is drawing up retaliatory tariffs for U.S. goods in case the two sides don't reach a trade deal. The list of American products is worth $84 billion and includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to negotiating after announcing a 30% levy on EU imports that will kick in on August 1st. And China's economy grew more than expected in the second quarter, driven by front-loading and strong exports to markets outside The U.S. GDP expanded 5.2% year-on-year, and industrial output rose 6.8% in June from a year earlier. But a more pronounced slowdown is likely in the months ahead due to trade tensions and weak consumer demand at home. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the president's open to talk.
The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk. We are open to talk, including to Europe. If in fact they're coming over, they'd like to talk.
Up next on the program, we'll catch up with Michael Froman of the Council on Foreign Relations, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Later this morning, 8:30 Eastern Time, CPI in America. Before that, a lot of earnings, including this hour. Numbers from JP Morgan. Next hour, Wells Fargo. After that, Citi. In focus this morning in the pre-market, one name. It's not a bank, it's a tech firm. It's a mega cap tech firm. It's NVIDIA. NVIDIA higher in the pre-market off the back of this statement. Filing applications to sell the NVIDIA H20 GPU once again. The US government has assured NVIDIA that licenses will be granted. A surprise earlier on this morning.
And this is a huge part of NVIDIA's business. And there was a big question about how much their revenue is going to go down as a result of not being able to sell into China. Does that reverse? All we know is the $4 trillion company just got a little richer.
Stock is up by 5% in the pre-market. Futures doing nicely off the back of that, positive by 0.4%. Under surveillance this morning, the president's open to talk.
Mr. President, you've praised European countries today as standing up for Ukraine, as being strong. Will you allow them to continue to negotiate tariffs lower than 30%?
The deals are already made. The letters are the deals. The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk. We are open to talk, including to Europe. If in fact they're coming over, they'd like to talk.
Here's the latest this morning. President Donald Trump signaled he's willing to continue trade negotiations while the EU finalizes a list of countermeasures targeting $84 billion in U.S. goods. Bloomberg's Mike Shepard joins us now for more. Shep, welcome to the program, sir. It looks like we've got the list. The retaliation from Europe is being prepared. How's the U.S. responding?
Well, the U.S. hasn't responded yet. This kind of broke late in our time yesterday. So it'll take a little bit of time for U.S. trade officials here to kind of gather it. It's not coming entirely as a surprise. The European Union has signaled, pretty openly that it would take countermeasures if it could not reach a deal with the U.S. that would avert some of the heavier tariffs that Trump is promising. Now, when the president says that he is open to talk, European officials are increasingly concerned that it's a one-way conversation. And as you heard the president say, for him, the deals are the letters that he has posted on his Truth Social platform, warning countries and trading partners like the EU of the tariffs that they should expect if they can't somehow come to better terms with the U.S. by this August 1 deadline. Now, what does that mean? For the EU, they have been anticipating at least a baseline tariff of 10%. And that is something that EU officials, including here in Washington, have signaled that that might be something that they could live with. The higher 20% tariff that Trump had indicated could be coming with a new list that was beginning to circulate last week of levies that would be imposed on countries and trading partners around the world, they could negotiate perhaps around that. But the 30% level in the president's letter over the weekend, that's an eye-watering level that would really be an impediment to trade. And we heard that from Marko Sefcovic himself. He is the European trade negotiator, and he will be discussing this further with U.S. counterparts to see if they can somehow reach some solution to this impasse that is beginning to take shape and worrying producers in the European Union as well as customers here in the U.S. about the potential for our higher costs there, John.
Shep, just quickly, just an example of how quickly things can change down in the nation's capital. This U-turn on NVIDIA, you've been tracking this story, I know. What's your reaction to what we've heard from that company overnight?
Well, it's funny. Last week, Jensen Huang was in Washington to meet with President Donald Trump. We don't know what was said behind closed doors, but it's certain that he was offering the same message to the president in private that he has been making publicly, that U.S. export controls don't work, and that they are impeding NVIDIA's ability to serve as essentially the American tech stack for the world as other nations and other markets pursue artificial intelligence. This is the area that NVIDIA has carved out for itself as a leader with its groundbreaking chips, but it has not been able to sell many of those AI chips in China at all, thanks to U.S. restrictions. And Jensen Huang, the CEO, has warned that ceding the China market and walking away from it simply hands it over to Huawei Technologies, its top Chinese rival, and one that could also make inroads in other markets around the world, John.
That stock is up by 4.9% of the pre-market. Shep, appreciate your time. Mike Shepard there on two stories, the relationship with Europe and the so-called U-turn on NVIDIA and some of the chips they sell into China. Joining us now to discuss, Michael Froman, the president of the Council on Foreign Relations. Michael, welcome to the program, sir. Just want to pick up on a line that you've said recently. We sometimes forget that other countries have politics too. How do the politics of Europe influence the negotiations over the next few weeks?
Well, I think that's the right question because Europe has its backup. It's not used to being treated this way by the United States. And they've gone back to their usual approach of trying to find products that they think are particularly sensitive, both economically but also politically in the United States. So bourbon from Kentucky and Boeing from across the United States that they'll put tariffs on in order to retaliate against the U.S. The question is, President Trump has said if a country retaliates, he'll simply add the retaliatory tariffs on top of the tariffs he's interested in imposing. So the 30 could go to 40 or 50 or 60. At some point, it doesn't matter. You get above around 50% tariffs, the trade is prohibited, and you're not going to bring in anything at all from that market. And that's the risk that we face if they can't reach a real deal, not a unilateral letter, but a real deal negotiated between the two.
So Brussels is looking at U.S. sensitive political pockets potentially for their retaliation. But what about the politics within Europe? Can the European Union really cajole all their members to get on board with one framework and one deal with the United States?
It's really hard. I mean, the competence for trade policy lies with the European Commission, not with the member states. But if major countries object to what the Commission wants to do in terms of imposing retaliatory tariffs, it's very hard for the Commission to move forward. And as you said, there is a division. Some are more willing to engage in a trade war with the United States. Others are trying very hard not to escalate tensions. And those differences have to be worked out in Brussels. I think President Trump has probably made it easier for them because the 30% proposal over the weekend has really galvanized opposition. They were already angry, but as your previous guest said, they sort of got used to the idea that they might have to pay 10% tariffs, that they might have to reduce some of their tariffs. I think the question is, what are they willing to do in a real deal? Are they willing to address some of the regulatory issues that have become an irritant in the relationship around the digital economy, digital services, et cetera, around data governance? Are they willing to reduce tariffs? Probably that's the easiest issue, where they have higher tariffs than we do. We have a 2.5% tariff on cars. They have a 10% tariff on cars. There's no reason why they shouldn't reduce their tariff to our level. But the question is whether the Europeans can get their act together, as you said, and put together a proposal that's compelling for the president.
Speaking of politics, there's an election in Japan in 5 days, but the Treasury Secretary is going there at the end of the week. Do you think after this election, it will be a pathway for Tokyo and Washington to strike a deal?
You know, I think the Japanese hope that they could strike a special relationship with the United States, given the security issues at stake right now in the region, given their cooperation on so many issues regarding China, regarding Ukraine over the last several years. That did not happen. I don't know how much, depending on what happens with the election, I don't know how much a change in government, if there is a change, is going to really affect their position in these negotiations. I think they've just got to come to terms that they're going to face higher tariffs coming into the U.S. The problem, of course, is notwithstanding all the Japanese investment in the United States, including in the auto sector, they still import a lot of autos into the U.S. and auto parts, and those are now being talked about to be 25% tariffs or higher. And so that is going to be a real burden on them, and they're going to have to figure out whether they can invest more in the United States and how quickly they can invest more to avoid meeting those kinds of tariffs.
Michael, always appreciate your time. Michael Froman there, the president of the Council on Foreign Relations. Just on the Japanese election, might not influence the outcome of trade talks, certainly shaking up this bond market in Japan.
You have deficits that have been climbing, and you've got politicians promising tax cuts, and that is a toxic mix, toxic brew for all of the bond vigilantes out there.
With fixed income worldwide. Up next on the program, bank earnings just around the corner. Gerard Cassidy of RBC.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago. Because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Starting the week in positive territory, just about. Monday at the close, positive by a little more than 1/10% this morning. We had some weight to the rally, up another 0.4%. Nvidia in focus, we'll get to that name in just a moment. It's given the Nasdaq a lift, up 0.6% in early trading. In the bond market, 2-year, 10-year, 30-year, a little bit snoozy going into CPI later on this morning at 8:30 Eastern time. Bond yields coming in at the long end, down by 2 basis points on 10s and on 30s. Anything but snoozy over in Japan. Check out the long end of the curve. Just want to look at 30s. 30-year yields now through 3%. They were 100 basis points lower last summer. Big changes in Japan.
And it's a big change with respect to the political appetite to incur more debt at a time when a quarter of their annual budget is set aside currently for refinancing debt that was issued at those lower rates and now have these higher rates. Meanwhile, we've got politicians promising tax cuts and they're actually gaining in popularity. Raises a question. Everyone wants the privilege to act recklessly, as used to say. In the United States, they took advantage of that, and now the rest of the world has to pay the bill because ultimately there is less appetite among debt investors to absorb that and to accept some of the recklessness.
To quote the bond strategist in the White House, things have got a little bit yippy at the long end of the curve, and not just stateside, but worldwide.
Arguably more so worldwide, and arguably more so because now suddenly there's a reckoning. What does the rest of the world do with U.S. tariffs and the requirement that they spend more on a number of provisions in order to appease the president? That's causing some of the concerns and some of the desire to really raise more money through debt sales.
The Treasury Secretary of the United States about 30 minutes away. A conversation with Scott Besson on this program at 7 a.m. Eastern Time. 3 hours away from the cash open. Let's get you some morning movers, including Nvidia. Here's Danny Berger. Hey, Danny.
Hey, John. We start there, and it really is doing the heavy lifting for this equity market this morning. Nvidia in a blog post saying that it would resume the sale of its H20 chips to China in about face from the Trump administration. Now, we don't yet have confirmation from the Commerce Department. Even so, this would add billions in revenue back into Nvidia. Shares higher by 5% easily will be at a new record if it opens up at this current price. Now, elsewhere, MP Materials, this is a U.S.-based rare earth company. Reports suggest that Apple will be investing $500 million into MP Materials. This also seems to be a nod to the Trump administration, which wants Apple's to source more from the U.S. As part of this, they're also going to be building a rare earth facility in Texas. So MP Materials up 10.33% in the pre-market trade. Now, speaking of investments, also got an announcement of a big one coming from the AI data company CoreWeave, up to $6 billion. They will be investing in a new data center in Lancaster, Pennsylvania. Shares are up 8%. They say there is more demand, so they need to meet that supply. They should have the first 100 megawatts available for customers to use in 2026, John.
Danny, thank you. Appreciate it. Here's the latest this morning. The numbers from JP Morgan dropping early. If you want the cheat guide, I'll keep it short. B, something like that. Bloomberg Shonali Basak has more. Hey, Shonali.
So many beats, John. You're looking at JP Morgan coming in strong. Interesting to see a healthy rise in the stock pre-market off the heels of these earnings, given the stock price appreciation so far. You have a lot of promise here in credit quality. This is something when we kick off bank earnings season, a lot of investors will be focusing on how much are they really factoring in about the weakness of the consumer. And right now in the numbers alone, you don't really see it. You also see a lot of promise when it comes comes to those trading figures. A strong beat on the fixed income trading, and also a beat here when it comes to efficiency. Efficiency is something we'll be watching across all the banks because you are seeing compensation costs rising as activity rises back again in investment banking and trading, and also as net interest margins were expected to come under pressure. But right now we're seeing a lot of health at the start of bank earnings season.
The numbers are looking good. We're expecting a boom in trading numbers. Bramo, we got that and some from JP Morgan.
You got that with fixed income sales and trading revenue coming out in at $5.69 billion versus the estimate of $5.2 billion. That's a beat there. Guess what? It's also a beat when it comes to equities sales and trading revenue. Oh, guess what? Even net charge-offs is lower than a lot of people were expecting. I love this. Jamie Dimon saying that the U.S. economy remained resilient in the quarter. So the person who is saying people are getting overly complacent is seeing reason maybe for that optimism in terms of the economic activity underpinning some of these results.
The man at the top of the bank says significant risks persist, including from tariffs and from trade. Shanali, we've got to get a look at the outlook as well. What are expectations for the outlook on net interest income for the year ahead?
They're looking pretty good so far. Remember, when we are looking at the problem here is the fact that interest rates might decline at some point this year. Of course, there is a lot of uncertainty around that, but there are a lot of questions here in terms of how much JP Morgan will actually be able to squeeze out of that consumer in the credit card books. Remember, when you look at Federal Reserve data, they have actually declined when it comes to balances across the street. So we are looking at strong numbers here across the board, but managed net interest income for the quarter, I don't know if you noticed this, John, that's actually below expectations right now. So we'll see ultimately how it pans out through the end of the year.
Stay close, Shanali. We'll come back to you in just a moment. Shanali Basak there of Bloomberg, off the back of the numbers from JP Morgan out just moments ago. A beat across the board here, everywhere you look, for equities and sales trading revenue to fixed sales and trading as well. Just the guidance coming from JP Morgan's Jamie Dimon. Think about what he said 3 months ago. Maybe when we do this call next quarter, we won't be guessing. Fact of the matter is, we're still guessing, but maybe this story is just less relevant given the resilience of this economy so far.
And it's not just the economy. It's also, there does seem to be enough certainty among corporations for them to start doing deals again. He said that investment banking activity started slow but gained momentum. This is what we're hearing across the board. So yes, maybe there isn't full certainty, but the certainty that they have certainly is positive enough to continue with a pretty rosy outlook.
Stock is up in a pre-market by 1.3%. To extend the conversation, joining us now, Gerard Cassidy of RBC. Gerard, you've had a look at the numbers. Your first take, please.
Jonathan, I think as you pointed out, the numbers were very strong across the board. Even when you exclude the one-time item that they identified, earnings came in better than expected, and you guys have highlighted some of the key areas. One particular area that I thought was interesting was the provision for credit losses was lower in the prior quarter. Shanali pointed out net charge-offs had fallen, so credit is quite strong, and this is a good read-through to not just the other money center banks, but also the regional banks. And then, as you guys have highlighted, investment banking numbers came in better than expected, and the trading numbers, particularly FICC, better than expected.
Gerard, I'm pleased you picked up on the provision for credit losses. Just compare what the bank is doing to what the bank CEO is saying. Jamie Dimon's talked about complacency in markets. At the same time, provision for credit losses is lower than expected. Do I listen to one thing and ignore the other?
John, good point. But to Dimon's credit, he's always a individual that is looking over his shoulder, looking around corners to make sure that this company is well positioned should there be any surprises on the horizon. He never rarely gets overly optimistic on credit. So on one hand, yes, we need to listen to what he says, but the numbers speak for themselves, and credit is very healthy, not only for JP Morgan, but for the industry as well.
Gerard, what do you make of the idea that we don't really have certainty with respect to tariffs? Many policies still very much up in the wind, and yet it seems like corporate America, as reflected at least by JP Morgan and Delta, have reflected a certain level of confidence. Do you see that reflected in other banks and other rhetoric that we're hearing?
Lisa, it's a good point, because when you think about when they reported first quarter results, obviously it was in April, right at the height of the uncertainty on tariffs. There's less uncertainty today. I think everybody has resigned themselves to the fact that tariffs are going to stay in place and prices will be higher. But so far, even though I know the tariffs haven't worked their way through inflation, the inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence today that the tariffs are not going to cause what many people were thinking about in April, a recession. You might remember many economists listed the probability of a recession this year, and now they're reversing that, and that's showing up in some of these banks. And I think you're going to hear other banks talk very similarly to what JP Morgan is showing today.
How much is a steepening yield curve, which we've talked about so much with reflection of what this means for the U.S. government's credibility, what this means for inflation, et cetera, how much is that benefiting the banks beyond what a lot of people have been expecting?
It's so important that investors fully embrace a steeper yield curve. And when you think about, even if the Fed cuts 25, 50 basis points this year, it brings the Fed funds rate down to just under 4%, let's call it. And if the 10-year stays anchored at 4.5, 4.75, that's a positive slope, obviously. It's been 20 years, Lisa, that we've seen a Fed funds rate over 3% with a positive slope to the curve. That's very positive for banks' net interest margins as they reprice deposits lower. However, asset yields will increase as they renew those securities and loans made back in 2020 and 2021 at much lower yields. So that's very positive.
Jared, last time around, the banks got a pass on these earnings calls. They got a pass because we were seeing immense policy volatility through the month of April. When they get on these calls a little bit later, Wells Fargo, Citi, JP Morgan, the big banks again tomorrow and the day after, did they get a pass this time around?
It's going to be interesting, John, because I think we're going to be focused on the second half of the year and what it means going into 2026. We also have to remember, I think you're going to hear quite a bit of discussion about the regulatory outlook. You saw the stress test results, which were quite positive for all the big banks. And now we're expecting a much watered down Basel III endgame, which is the final capital regulation that the banks will have to adhere to when that comes out probably in the fall. So I think not so much a pass, but a real keen interest on what the second half brings, particularly with loan growth and what the outlook might be for next year.
Jared, stick with us. That name is down in the pre-market now by just 0.1% off the back of a stunning rally through the month of April, May, June, and into July. We've had a move of something like 40% off the lows of the KPW Bank Index. So a lot baked in here. Expected a boom in trading revenue off the back of the volatility in the first month of the second quarter. Now it's about the second half. When they come out, and as you pointed out just yesterday, and say things like the pipelines are full, we're ready to go, are those plans derailed or delayed?
Well, and right now, Jamie Dimon is saying that a lot of the investment banking activity is gaining momentum. Can that be stalled? Is that a reason for some of the caution? Could something happen, say, another level of tariffs that causes people to pull those deals? When you take a step back, in some ways, these big banks are a perfect microcosm of a whole host of different trends. They have to answer what companies are getting in terms of conviction from some of these tariffs. They also have to answer how much efficiency they're getting from artificial intelligence. And they, I think, are at the vanguard of the technology trade as well. And I hope that that is something people really ask questions about.
We got the beat. Here's the race.
Yeah.
Here's the outlook from JP Morgan. Full year net interest income, about $95.5 billion. They had seen 94.5. I know we say this a few times, but when Jamie Dimon of JP Morgan comes out in the weeks before earnings and talks about complacency in markets, and we sat around this table and said, what's he going to do next week? Raise guidance? What have they just done? Raise guidance?
Jamie Dimon is the quintessential risk manager, and he's also somewhat politically minded. He is trying to position himself in certain ways to send messages to certain political powers. It isn't necessarily a reflection of the business. He has this mantra where he'll come out and he'll say, you know, if there's nuclear war, JP Morgan will be fine. If there's all the catastrophes in the world, JP Morgan will withstand. And that's sort of his mindset, so it isn't necessarily indicative of what they're doing in the business.
The latest from JP Morgan this morning, it's a beat and it's a raise. The stock is positive by 1% in the pre-market. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahira Arnott. Hey, Yahira.
Good morning, John. Fed Chair Jay Powell has asked the central bank's inspector general to review the $2.5 billion renovation of its Washington headquarters. Some Republicans and Trump appointees have criticized Powell for cost overruns around the project. It's a new line of attack as the president continues to criticize Powell for not cutting interest rates further. Meanwhile, Apple is under increasing pressure to rescue its struggling AI efforts. Investors want the tech giant to break with tradition by making a big acquisition and going after top talent more aggressively. The iPhone maker shares have fallen over 16% this year, lagging peers such as Meta, which, as we know, is spending lavishly on AI. And India's Civil Aviation Authority is ordering an inspection of cockpit fuel switches on Boeing 787s and 737s after a report linked last month's Air India crash to a fuel cutoff. Operators must complete the inspections within a week. Investigators' initial Air India crash report says there's no evidence so far needing action over the Boeing aircraft or its GE Aerospace engines. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, earnings season begins.
These banks are making returns on tangible common equities in the mid-teen range, high-teen range. They're generating value. They're creating value right now. We're more cautious on where stocks are trading at.
Is that cautiousness warranted? It's a beat and raise from JP Morgan, first out the gate, kicking off earnings season on Wall Street. That stock is up by 0.8%. Up next on the program, Wells Fargo, just around the corner.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Starting this morning with a beat and raise from JP Morgan. Decent guidance coming out of Nvidia on what they can sell into China. Stocks are higher, up a third of 1% on the S&P, on the Nasdaq 100, up by 0.6. Under surveillance this morning, earnings season begins.
We're more cautious on where stocks are trading at. Valuations are unattractive given still elevated uncertainty on the macro side. The deregulation side is certainly a positive. These banks are making returns on tangible common equities in the mid-teen range, high-teen range. They're generating value. They're creating value right now.
Just moments ago, numbers from JP Morgan, better than expected. That stock is higher by 0.75%. Just seconds ago, numbers from Wells Fargo, not so good. With the numbers, here's Sonali Basak. Hey, Sonali.
John, while you had JP Morgan with a beat and a raise, you have Wells Fargo with a miss and a staying in line when it comes to net interest income. So you do have, remember, JP Morgan also slightly missed on net interest income for the quarter. It's the outlook now. How much more juice can you squeeze out of the consumer? I had mentioned costs. We're also going to be a big focus this earnings season, I would say, for Wells Fargo. Interesting to see credit quality is also really good. This is the really good news for both JP Morgan and Wells Fargo, coming in better than expectations. However, non-interest expense. This is the expenses you have control over, coming in a little bit higher than expected. The setup here was that Wells Fargo was already trading at a richer price-to-book ratio than you had at Bank of America, for example. There's a lot of promise in the stock with the asset cap lifting. So now for Charlie Scharf, it's a show me the money story. They did miss on investment banking as well. These are business lines that they want to grow over at Wells Fargo now that that asset cap is lifted. So high bar now, not everyone can be JP Morgan. They came in at more than a 20% return on tangible common equity. No one thought that they would get that this quarter. So can the rest of the banks keep pace?
Sonali Basak with the latest. Still with us, Gerard Cassidy of RBC. Sonali repeated a few times, just on Wells Fargo. Is it a new dawn for this bank with the lift of the asset cap?
John, I really do think it is a new dawn for them. And it's well said by you because the lifting of the asset cap is significant. This company has been stuck in asset cap prison, if you will, since 2018 when they signed the cease and desist order with the Federal Reserve. And now that the asset cap is lifted, the C&D is not lifted yet, but the asset cap will allow them to grow. In fact, management has pointed out that one of the areas that has been holding them back is in the investment banking capital markets business. So we do expect that to be the first area to benefit from having the asset cap lifted at this time.
That said, these results, the fact that they missed expectations on several different measures, does it just show that this is a winner-takes-all or winner-takes-most economy with respect to corporations, with respect to households, just the sense that the big are getting bigger?
I think it shows that, again, with the asset cap in place for almost the entire quarter, you really need to grow your balance sheet in this kind of environment. And they, of course, cannot do that. Now they will going forward. And in fact, when you take a look at, going back to the JP Morgan results, I thought I read that loan growth was up 5% year over year. And that helped them with their outlook for their net interest revenue for 2025. So I think that it's very competitive, of course, and it's really being able to grow your balance sheet to help offset any pressure that they may be experiencing in their net interest margin.
I guess to rephrase this, is JP Morgan consolidating business from a lot of other banks other than representative of a globally good environment for banking? And I say this at a time when we know they've acquired assets from some of the regional banks that had been struggling, and it does seem like there is an advantage in size as well as just footprint.
It's interesting that size certainly comes with economies of scale. But one of the things we have to point out with JP Morgan compared to Wells, for example, is JP Morgan has a much bigger consumer business driven by their credit cards. And the return on equity in their consumer business at JP Morgan was an astounding 36%. And that's what really drives the value here. Bank of America is close to JP Morgan on the consumer side, but Wells is not there yet because Wells doesn't really have the presence in the credit card business that JP Morgan has, which is a very profitable business for the credit card players.
Gerard, later this morning we'll hear from Citi, then we'll get numbers from Bank of America, from Goldman, from Morgan Stanley through the week. Based on what you've seen so far and what you can read through the tea leaves for the second quarter, what kind of bank do you think does well in this environment, and what kind of bank is going to perform in the year ahead?
I think, John, the banks that do well in this environment are the ones that are funded with cheap core consumer deposits. When you look at a Regions Financial, which is a regional bank, of course, and 30% of their deposits are interest-free. And when you have levels of deposits that high with that you don't pay interest on, and the Fed funds rate is obviously over 4%, you could do quite well. The other area that we're watching is on credit. So the banks that show good results on credit, and both these companies did, that too would do well. And of course, as you already have identified, the capital markets investment banking business is important, and the big money center banks are the players there, along with, of course, Goldman and Morgan Stanley.
Gerard, the first reaction in markets isn't always correct. And today might be an example of that, because based on the tone of your conversation, it seems like you're more interested in what Wells Fargo does in the year ahead than JP Morgan, even though JP Morgan increased their expectations, their outlook, and Wells Fargo didn't. Am I getting that right?
No, you certainly are getting that right. And again, it was idiosyncratic, of course, to Wells for having the asset cap lifted. So we really have to see how they perform over the next 12 months. And ideally, I think they're going to show some good growth, which they haven't been able to do because of that asset cap. And that's not to take anything away from JP Morgan's results or the outlook for them as well. But it seems to us that, the real upside potentially could come from Wells Fargo when we're sitting here possibly a year from now.
Hey, Gerard, appreciate your time. You're going to stick with us, I'm pleased to say. We'll catch up with you a little bit later this morning. Numbers from Citi about an hour away. So far, so good. Numbers better than expected, almost across the board. Let's take JP Morgan. Expected a boom in trading. Got one. Better outlook. Got one. The surprise beat in investment banking and fees related to some of those activities, I think, is indicative of maybe the cloud starting to clear just a little bit. Perhaps some renewed confidence in this economy off the back of the resilience we've seen over the past few months. And I think a lot of people at these banks will hope that continues for the year ahead.
Jamie Dimon pointed to the one big beautiful bill in Washington, D.C. passing, and that gave some confidence to corporations of what at least the tax and investment landscape would look like going forward. And maybe that was enough for them to really pull the trigger, for them to see the increase. Again, I want to see how much they're consolidating business from other banks and how much actually in absolute this is an area that's picking up.
Also, he noted the potential deregulation for this continuous push from the Trump administration to deregulate in all parts really of the economy, but he had a warning. Quote, significant risks persist, especially from, quote, tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficit, and elevated asset prices. When it comes to tariffs, you hit the nail on the head. Is anything different from April? It isn't. We owe uncertainty, but the market is just shrugging this off because they think there's a threshold that Trump will, if potentially the markets push back, he will unwind.
They've always got a warning, right? I'll freak out when Brian Moynihan starts to look worried on TV. Because otherwise he's super direct, right? Very calm, everything's okay.
Yeah.
Jamie's running around saying clouds, storms, all of those things. When Brian starts to worry, I'm going to start to worry.
Yeah, when Brian says my hair's on fire, well, we'll all duck.
There's a reason for it. Equity futures right now in the S&P, positive by 1/3%. In the next hour, the U.S. Treasury Secretary Scott Bessent, Sarah Hunt of Alpine Saxon Woods, Elias Galou of Bank of America, Matt Hornback of Morgan Stanley. Next up, Scott Bessent, just around the corner.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. there has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There's so much in this market that is really attractive.
If you're looking at kind of what's been working in markets the last couple of years, it's quality stock.
But we do favor large caps in particular because of adaptability.
What I think has surprised everybody, ourselves included, is the sheer resilience of the U.S. corporate sector.
You're going to see a kind of beat and raise scenario that is the next leg of the market driving higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with equities close to all-time highs. Equity futures on the S&P positive by 0.4%. On the Nasdaq up by 0.6%. Bank earnings out just moments ago from JP Morgan. It's a beat and a race.
Yeah, right now people are looking at the potential for these banks to keep making money, not only from interest being significantly higher, but also investment banking activity coming back. And this really goes to the difference between Jamie Dimon's warnings of gloom and doom and the reality of a beat and a raise, which is what we just got.
It's 60 minutes time, another read on the banking sector on Wall Street. We'll hear from Citi. Look out for that in 90 minutes time, 8:30 Eastern time. U.S. inflation data in focus.
This is going to be in focus, especially for the administration, which has been talking about the fact that inflation has been coming down. We had 4 consecutive prints of better inflation numbers. Will we get a 5th today?
Equity futures this morning higher by 0.4%. Coming up this hour, the Treasury Secretary Scott Bessent ahead of President Trump's August 1st tariff deadline. Elias Galou of Bank of America on an excessively bullish global fund manager survey, and Matt Hornbeck of Morgan Stanley counting down to US CPI. We begin this hour in Washington. President Trump leaving the door open for trade talks and piling on the pressure for the Fed to cut interest rates.
We're still willing to talk. Literally every country wants to make a deal. We have no inflation. Our stock market hit record highs. With no inflation, we should be at 1%. Thanks as well to Treasury Secretary Scott Bessent, who's doing a fantastic job. He goes on television and he calms the market. I go on television, I rile the market.
It's time for some calm. Joining us now, the 79th Secretary of the Treasury, Scott Bessent. Mr. Secretary, welcome to the program, sir. Let's pick up on that theme. Not you calming the markets, but on inflation and where rates should be. As Anne-Marie pointed out, we've had a string of softer than expected inflation reads in this country. We've had 4, we might get 5 at 8:30 Eastern time. Why do you believe that's signal and not noise?
Well, I mean, there's some persistence there, Jonathan. And look, I
do have access to the number the night before, but when I'm coming on TV, I don't look at it, so I don't know what the number is going to be at 8:30, and I wouldn't, I don't know whether it's going to be down, up, or flat, but I wouldn't put too much emphasis on one number. I think it's the trend, and I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
And there are some people on the FOMC, the Federal Reserve, still worried about the prospect of that happening through the summer. We've all sensed the frustration from the White House across the administration with Fed Chair Jay Powell. And a lot of confusion, I think, at this point that maybe we can address in this conversation. Is firing the Federal Reserve Chair under active consideration in the White House and the Treasury in your administration?
President Trump said numerous times he's not going to fire Jay Powell. He's working the refs. And I've said before, I'm a basketball fan. There are two schools of working the refs. There's the Bobby Knight School, and there's the Dean Smith School. President Trump seems to prefer the Bobby Knight School. And I'll tell you, I went back over the weekend and looked, and Bobby Knight won 3 NCAA championships. My hero, Dean Smith, only won 2.
The NEC director, Kevin Hassett, I'm not sure what you'd call him, but he was asked over the weekend, can the Fed chair be fired? He said that's a thing that's being looked into. How should we understand those comments?
Look, and I will point out, Kevin was a collegiate basketball player, and I think, as President Trump said, he's not looking to fire Chair Powell. And as I've said, I'm not going to comment on future policy or future mistakes the Fed will make. I'll only comment on past mistakes. And look, they've had some big forecasting errors, and this may be one now.
Is there a reason for not firing him? And I asked that question because the president's also said that his term is about to expire in May of next year. Is that the reason to ultimately just wait? Or is it something else? Are you convinced by the negative consequences associated with such a move?
Look, I think an independent central bank is very important for the conduct of monetary policy, and we can see that in terms of both the financial markets, the term premium, and longer-term debt.
You said previously the interview process would begin later on in the fall. There's been plenty of speculation as to whether that process would be brought forward. Mr. Secretary, do you still, as far as you understand, believe that's when the interview process to replace the Fed chair will begin in the fall, or has a formal process already started?
Well, look, there's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Do you see any merit at all in selecting maybe a candidate that's already on the committee on the FOMC versus taking a look at someone outside of the Federal Reserve?
Again, there are a lot of good candidates inside and outside the Federal Reserve, Jonathan.
Has the chairman himself, the Fed chair Jay Powell, given you any indication whatsoever as to what he would do once his term has expired? Will he vacate his seat as the governor at the Federal Reserve?
Well, traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
Mr. Treasury Secretary, I'd love to talk to you about what's going on in NVIDIA this morning. Jensen Huang, the CEO, out in a blog statement saying that the company has, quote, provided an update to customers, noting that NVIDIA is filing applications to sell the H20 GPU again. The U.S. government has assured the company that licenses will be granted, and NVIDIA hopes to start deliveries soon. Can you attest whether or not that's true or not? The United States is willing to let NVIDIA sell H20s once again in China?
Well, again, Anne-Marie, I think that'd be a judgment that the Chinese indigenous manufacturers, namely Huawei and some others, already have an equivalent chip. So if there's an equivalent chip, then the NVIDIA H20 could be sold, because I can tell you the one thing that we do not want is a digital Belt and Road springing up around the world because other countries or China are substituting for our American chip manufacturers.
This is the same chip, though, that the Trump administration blocked with export controls in April. So why the change in policy now?
Anne-Marie, you might say that that was a negotiating chip that we used in Geneva and in London.
So this was part of the trade talks when it comes to Washington and Beijing?
Yes.
Was it a quid pro quo then? As you said, it wasn't, but was it potentially to make sure that you can get the licenses when it comes to rare earths?
Yeah, I think it was all part of a mosaic. They had things we wanted, we had things they wanted, and we're in a very good place. I expect to meet my Chinese counterpart, the vice premier, in the next few weeks.
So when and where will that meeting take place?
We're still working on that. The Chinese leadership has a big conclave at the beginning of August, so we're trying to work out whether that could be in a third country before or after that conclave.
Will the administration release the framework of the Geneva and London talks?
Well, we have released some of it, and I'll tell you that now having settled on tariffs, on the export controls, we can move on to the next stage of talks. And I think it's very important, both for the global economy, for the U.S. economy, and for the Chinese economy, for us to move on and talk about China opening its markets and the increased domestic and consumer production there.
Are you hoping to get to that next phase before August 12th, when that's currently the détente between these two economies?
Yeah, I think we're in a very good place, and I tell market participants not to worry about August 12th.
Should they worry about what's happening with Europe with respect to the 30% tariff rate? They don't seem to be worrying, but I'm just curious whether that's the final rate or whether the letter was part of a negotiation that Europe received from President Trump.
Well, Lisa, what I would say is President Trump's able to create a lot of leverage here, a lot of leverage, because he's indifferent. He's indifferent whether we take in the 30% rate or whether the Europeans come to us with a much better deal. As I've been saying for a while, that if countries or trading blocs don't come with their best deals, then the rates could boomerang back. So President Trump's leading this. And what I will tell you is that a lot of the deals, and this is where his leadership's been invaluable, a lot of the deals that I thought were excellent deals keep getting improved upon every time he takes up the maximum pressure strategy.
There is a theory in markets, and you don't even have to calm them. They're pretty calm. They're watching all of these rates, and they're not freaking out in parlance on Wall Street. They're taking this in stride. We're close to all-time highs, if not at all-time highs. Do you see this as giving a green light to Trump, to President Trump, to keep going, to take hardline approaches, and to keep trying to get better and better deals?
Look, I think this narrative of this obsessive focus on the market isn't right. President Trump views this as a generational opportunity to reset trade in a fair and sound manner for the American people. So the idea that some market ups or downs are going to be the deciding factor here is what we are concerned about, and President Trump is laser focused on, is getting the best deals, because we were not having fair trade, and now we're seeing with these countries coming to the table, the quality of the deals gets better and better. So we're not going to rush just because of some market deadline. Now, I think what the market's seeing is market's willing to look forward 3, 6, 12 months, and this is going to be good for the U.S., it's going to be good for the global economy.
If you do get some sort of signal from the market, though, that this isn't going to be good for the U.S. economy, is there a trigger point? Is there sort of a sense at which it acts as a gut check and sort of pulls back some of the negotiating tactics?
Look, I think the market understands what we're doing. Sometimes individual market people don't. Sometimes the television personalities don't. But good thing about President Trump is he always tells you what he wants, and what he wants is fair trade here.
I won't take that as a slight on me and my colleagues around the table, Mr. Treasury Secretary, but you did tell me on April 2nd, on Liberation Day, that this was the ceiling when it comes to those rates. But since then, we have actually had some tariff rates the president announced in letters higher than those rates he announced on that big chart on April 2nd. So is there no longer a ceiling when it comes to tariff rates when you are dealing with trading partners?
I think that I said if they come and they negotiate in good faith, then those are ceilings. And some of the talks got off to very slow starts.
So who's negotiating in good faith at this moment and who's not?
Again, I congratulated the UK the other day, as I told many of our trading partners, and Anne-Marie, I may have said on that day or a few days after April 2nd, I'd advise countries to move quickly because with President Trump, the first deals are usually the best deals. And the UK came in early. They got a great deal. And everybody else is kind of dragging right now.
Well, when it comes to Japan, you're headed there at the end of this week. Do you expect to come back with a deal?
I'm going to Japan to represent the United States government and the American people at the International Expo, which we used to know as the World's Fair. So this coming Saturday is going to be America's Day, and I'll be taking a delegation, includes the Labor Secretary, Deputy Secretary of State, will be representing the U.S. So this is a celebration of the U.S. more than trade talks.
Mr. Secretary, before you go, just a final question. I'm embarrassed to say that my knowledge of college basketball is nothing like yours, but I can tell you back in the 90s in English football, there used to be a concept of player managers. There used to be certain managers of football teams that also put themselves on the field and they played too. Effectively, they had two jobs. And I'm wondering from your perspective whether that's something you'd be interested in. We've seen that throughout the administration. Is that something you think that you could pursue, both the Treasury Secretary and the Fed chair?
Look, I think I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process, Jonathan.
Has he asked you?
What's that?
Has he asked you? Are you part of the process?
I am part of the decision-making process, but again, it's the final decision is going to be President Trump's.
Mr. Secretary, appreciate your time. Thank you. The Treasury Secretary there, Scott Bessent, on a range of issues, including trade and the future of this Federal Reserve.
Yeah, talking about how if Fed Chair Powell remains on the board, that it could be somewhat confusing after his regime as Fed Chair is up. I think that that's really notable. He also was talking about some of the negotiations and how the market is perceiving them and how it doesn't really matter, but sort of, it seems to be reflecting well on the whole process.
Also, Jonathan's last question, are you part of the process? It wasn't that he was part of the process as a candidate. He was part of the decision-making process, although he did say the final decision will come down to the President.
Important clarification. You can see the frustration with the Fed Chair, Jay Powell, on a range of issues. They'd like a decent understanding, I think, about his future once his term has expired. Will he be stepping down and vacating his seat as the Fed governor? And I think the Treasury Secretary was pretty clear about what the administration would expect to see in the next 12 months.
Absolutely. They are also hoping to see, when it comes to inflation coming down, an opportunity for this Fed to cut rates. Of course, the Fed will say, show me the tariff rates, then maybe we can cut rates. And then also interesting, I really think this is the clearest signal we've yet to get from someone in the administration or the Fed that Jay Powell is not staying on after he is Fed chair. He could stay on as a governor till 2028, but the Treasury Secretary is saying it's confusing if an ex-chair stays on the Fed board when a lot of people, including Democrats, are throwing criticism at this administration for this idea of a shadow Fed chair. I think that was a clear signal that Powell is going to go when his chairmanship is done.
We'll continue the conversation throughout this morning. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Big bank earnings are underway with JP Morgan and Wells Fargo both reporting in the last hour. JP Morgan shares are now lower by 0.4% after the bank saw a 7% jump in investment banking fees and stock traders posted their best second quarter ever. Meanwhile, Wells Fargo shares are lower nearly 2% after it cut its full-year guidance for net interest income. Next up is Citi, which reports in the next hour. Meanwhile, the European Union is drawing up retaliatory tariffs for U.S. goods in case the two sides don't reach a trade deal. The list of American products is worth $84 billion and includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to negotiating after announcing a 30% levy on EU imports that will kick in on August 1st. And staying on trade, the Port of LA saw its busiest June ever after a slump in May, with the whipsawing trade war pushing shippers to beat shifting deadlines. But trade forecasters expect a severe drop for the rest of the summer and through the holidays, which start in November, which is typically peak season at the ports. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, inflation is dead.
The economy is roaring, business confidence is soaring, incomes are up, prices are down, and inflation is dead. It's dead. Without us, you have no world. And we put our country on solid footing.
In just a moment, Sarah Hunt of Alpine, Saxon Woods.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Equities are positive by 0.4% on the S&P, up as well on the Nasdaq. Under surveillance this morning, inflation is dead.
The economy is roaring, business confidence is soaring, incomes are up, prices are down, and inflation is dead. It's dead. We're doing great. We have no inflation. Think of it. Our stock market hit record highs. Everything's hitting a record high. We're really running good with no inflation. Without us, you have no world. And we put our country on solid footing.
Inflation data due at 8:30 Eastern Time. About an hour away. Joining us now is Sarah Hunt of Alpine, Saxon Woods. Sarah, good morning.
Good morning.
Is inflation dead?
I think it's quiet at the moment, but I wouldn't completely rule it out. I think that there's some possibilities that it could pick its head up, but I think that it's hard for people to anticipate data when we spend a whole lot of time anticipating a bunch of stuff that didn't happen. So I think there's a little bit of fatigue there, so it's hard to say right now.
It's difficult to forecast. There's still some debate over the data we've already had. What's underpinning these softer than expected reads, and why won't it last?
So if we think about whether or not companies did a huge pull of inventory forward and or people started changing their behavior because they knew what was coming, you could argue why that's soft now and why it should rise if the rates are going higher. But you still see these moving of the goalposts in terms of timing, which allows companies to bring inventories back in again and refresh that. So I could see a lot of bumpiness in the data, and I also think that companies have had a lot of time to prepare for this. And if I'm sitting there, I want my margins to stay where they are, so I'm going to try to do whatever substituting I can. So I also think that there's probably a lack of understanding how much of that substitution has gone on, and I think that that is why it could be bumpier and less dramatically higher than people are expecting, because they're expecting a really fast move.
I just wonder, can we expect immaculate disinflation, ongoing immaculate disinflation where there is no pain in the overall economy at the same time that inflation is dead? Does that seem consistent with you, or is there kind of a tension right now between employment data that's pretty okay, albeit with very slow activity, and inflation that seems to be, maybe if not dead, in hospice?
It is one of those periods of time where figuring out what that data means is going to be tricky. It remains tricky. Earnings are going to matter for the stock market. Inflation is going to matter to some degree, but only if it's really surprising or gets much higher than people are looking for, and then investors really start to worry. The question is, what do those trends look like? I mean, to Treasury Secretary Bessent's point, it's not just about one number, it's about where the trend is going. If it looks like the trend is reversing, investors are going to like that a whole lot less.
Do you just not pay attention to the data at all and buy AI? Buy NVIDIA and just, call it a day?
It would have been the good trade for this year, right? I mean, that's sort of what happened, is that you had all this concern about AI going into the beginning of the year. Then you had the trade situation. Everybody started looking at every single earnings call from Microsoft or every hyperscaler to parse exactly what their spending was going to be. There was this little bit of freak out, and then everybody got over it really quickly. So that would have been that reversal. And that goes back to the idea that the companies that have growth and the companies that generate a ton of cash and have good margins are the places that they end up performing better than the rest of the market anyway.
It would have been good to get in on NVIDIA just last night, given the fact that they have a blog post out saying that those H20 chips that this administration blocked are now going to be able to go to China. How do you deal with this basically flip-flop almost within weeks or months of this administration when you're trying to direct what to do in a portfolio?
Well, I mean, flip-flop is an interesting term. I think it's more about, I mean, again, to Treasury Bessent's point, it's changing those dynamics may have been part of that discussion all along. So you have to assume that some of the things that are coming out as X or Y, maybe X or Y under certain circumstances, but if I change my mind, they're going to be different. So that's got to be, and I don't think that that's entirely different from things that the way the world works anyway. But I think that certainly in the near term, this administration has been much different about market changes than other administrations.
It's not just NVIDIA, it's AMD, just resuming shipments to China once their license clears. That stock is up in the pre-market as well.
Look, China's a big business for all of these chip providers. And the key question is, can they understand the rules of the game enough to create chips that are compliant with some of the constraints that have been put on them from the U.S. government?
Sarah, it's good to see you. Sarah Hunt of Alpine Saxon Woods. AMD is up by 5%, NVIDIA up by 4.4%. It's been a big morning already. Decent numbers from JP Morgan, a beat and a raise. We heard from the Treasury Secretary just moments ago on this program endorsing central bank independence. The formal process to replace Chairman Powell is already underway. It started. More on that in just a moment. Plus this, Elias Galou of Bank of America on an excessively bullish global fund manager survey. Plus, Danny Berger with your morning movers with another look at the nation's biggest banks. From New York, this is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television, top experts, great questions.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This from the Bank of America Fund Manager Survey so far this morning. Sentiment getting toppy. They say investor sentiment is the most bullish since February 2025. The biggest surge in profit optimism going back to July 2020, and a record surge in risk appetite over the past 3 months. Sentiment's getting toppy.
Yeah, although interesting when they say that this typically has been the indicator, they've sold, and it would have been a good thing to sell. Right now, they're not saying to sell. Because ultimately, how do you fade something that seems to be underpinned by a whole host of different themes that's just difficult to really just outright pull against?
We'll talk to Bank of America directly about that survey in just a few minutes' time. Futures up on the S&P, up by 0.4%, on the S&P 500, up by 0.6% on the NASDAQ. Some big stories out there for the banks and for big tech as well. With 2 hours until the opening bell, with your morning movers is Danny Berger. Hey, Danny.
Hey, John. Yeah, a lot to work through this morning. The first of which, about more than an hour ago, we got earnings from the big banks. Interesting to see JP Morgan give up its gains. At first, when it announced we were off to the races, a beat and a raise. Investment banking did better than expected. Traders, a record first half. You see some ebbing of that sentiment is now down 0.4%. Wells Fargo really taking a hit, though. It missed on its net interest income, even though it did see a beat on EPS. We also had some of the smaller banks reporting. Bank of New York Mellon, for example, they reported those shares are still up, but they are off of the highs of the morning, only up 0.5%. Really seeing sentiment again across these banking names start to ebb. For them, it was also a beat and a raise, really reinvesting a lot of their maturing securities at higher yields, helping them to up their revenue. Finally, moments ago, this breaking, John, you had mentioned it before the commercial break, AMD saying that it was preparing now to export its MI308 chips to China. This is a chip that had been blocked, but it says that the U.S. Commerce Department is now re-reviewing those licenses. When it initially got blocked, it said it was an $800 million hit it would take to its earnings. So with the resumption of that, shares are up 5.6%, John.
This is a big change in Washington, a big change we're following this morning. We'll keep tracking. Danny, thank you. On a radar this morning, Treasury Secretary Scott Bessent telling us not to put too much emphasis on this morning's CPI data, saying it's more important to look at the trend. Bessent adding the process to find a replacement for Fed Chair Jay Powell has already started.
What's interesting what's going on with the Fed, and he's talking about this process. The process has already started. He's saying he is part of the process in the sense that he is giving that guidance to the president about a decision, almost sort of put some distance between himself and potentially going over and running the Fed. Then he said this: traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of shadow Fed chair causing confusion in advance of his or her nomination. I can tell you, I think it'd be very confusing for the market if a former Fed chair to stay on. This is the big question for this administration. After Powell's chairmanship is on, will he stay on as governor in 2028? I think it's a clear signal that it's not likely.
There's a larger issue here, which is how does this administration want to reshape the way that the Fed really does approach monetary policy. Is there some sort of larger overhaul that Kevin Warsh was really alluding to, regime change and how they calculate certain aspects of the economy? And that, I think, increasingly is going to be the question as we parse through who the replacements to some of those empty seats will ultimately be.
We witnessed all the pressure on Chairman Powell over the weekend, and we woke up Monday morning and hardly saw any movement in the price action whatsoever. I think the fact that we have Scott Bessent in the Treasury seat right now brings this market a lot of comfort to come out and talk about central bank independence the way he did, draw a line under it, and hopefully move on. I think is some of the reason why you haven't seen markets move in quite the way they would if Secretary Bessent was saying the kind of things that Kevin Hassett was over the weekend.
People view him as sort of the arbiter of calm, and President Trump obviously looks at him to that, given the fact that he says, I come out in royal markets, and he comes out and he calms them. At the same time, Scott Bessent seems to be coming out and saying the market is taking everything in stride because they see the long game. And overall, the long game is not to disrupt the independence of the Fed, and it's not necessarily to create a trade war just for the sake of it, but it's ultimately to get income and to create a more fair landscape. You know, whether that's actually what the market decides after we see the rates, et cetera, we shall see. But I think it gives you a sense of what the framework is that he sees.
He understands the bond market.
Yes.
If you want lower rates, don't fire the central bank governor. If you want higher rates, fire the central bank governor, or the Fed chair in this case.
I'm guessing he wouldn't come out and say drop rates to 1%, and he thinks that that's appropriate for the Fed funds rate, because probably if Scott Bessent were to say that, you would see a real reaction in the long end.
We'll have more on that conversation in just a moment. I want to turn to the bank results we've had so far. Kicking off on Wall Street earlier this morning, JP Morgan reporting equity and FIG trading revenue that beat estimates. On the flip side, Wells Fargo missing net interest income estimates and cutting its full-year guidance. Two very different stories this morning.
Yeah, although one consistency, and that is that their loan loss provisions came in lighter than expected, both of them. So if you're worried about credit quality, well, it looks like that's not as much of a concern. You know, you see both of the shares down, and they're down for different reasons. JP Morgan shares have been up some 40% this year. I mean, this has been the high flyer, and so some people are saying the bar is just too high at this point for them to cross. Wells Fargo is more interesting, especially given what we heard earlier this morning. How much do they have more optimism ahead of them because of the, what was it, the asset cap jail that they had been in that had been lifted? Is that something that they can see? I mean, how does the market judge that if they're not giving any good guidance to that extent?
Citigroup's up next. We'll hear from another one in about 25 minutes' time. I said two big sector stories, one in the banks, Lisa going over the financials. We need to talk about tech. Chip makers rising in the pre-market. NVIDIA planning to resume selling its H20 AI chip in China. AMD, just moments ago, also preparing to resume shipments of its MI308 chip once its export license is cleared. It's a U-turn from the administration.
It is a U-turn. This chip was developed under the Biden administration, so it could be export compliant to send to China. Trump administration comes in and they say you cannot sell the H20 to China. And guess what? We have had Kevin Hassett, we've had the Treasury Secretary in the past say this is not quid pro quo. We're not going to make sure that we do anything that goes against our national security. But what did he say to us this morning? NVIDIA chip decision is part of a, quote, mosaic of the China talks, basically saying this was part of an agreement, and he used the term a chip we were going to use when it comes to the deal-making, the détente they had with Beijing.
Yeah, he also said something else that I thought was really provocative and interesting, which is he doesn't want, or they don't want China creating a digital Belt and Road. And this idea, the nod to you want to win the global war for AI infrastructure, and you can't do that if you really separate chips from the U.S. going into basic Chinese goods, not necessarily military, but basic Chinese goods.
Two big movers in the pre-market, lifting this equity market higher by 0.4%. Let's talk about this stock market and turn to investor sentiment. The Bank of America Fund Manager Survey out just moments ago. The title, Sticky Toppy Pudding. Joining us now, Elias Galou of Bank of America. Elias, welcome to the program, sir. Just across the board, optimism, optimism, optimism. You and the team have called it toppy. Is this a sell signal?
Look, I mean, yes, one of our famous trading rules that we highlighted in the fund manager survey did trigger a sell signal. I'm talking about the FMS cash rule, which really look at how investors are invested in the market. And this month, the cash rule fell below 4%, which did trigger a sell signal. And there have been roughly 17 sell signals since 2011, with an average return for the S&P 500 of -2% over the following 4 weeks. But really, I think, John, what stands out from this month fund manager survey is hedging, rather than just saying that where the market is getting toppy. Investors are very much more inclined to hedge their positions, what did really well in their portfolio in 2025, and rotate towards assets that have underperformed in the first semester, rather than just sell outright their position and retreat for the rest of the year. And in fact, if you look at market price action since the beginning of the second semester, it's corroborating the bottom line from the fund manager survey. Assets that had underperformed in the first semester, like cryptos, like home builder stocks, biotechs, and even renewables, are now doing quite well in the second semesters. So we think hedging is really the word to remember this month.
Does that mean hedging some of the big tech exposure, given the rapid increase to allocation in that space?
Yeah, I think it's really important to highlight the rapid increase in tech allocation. I mean, over the past 3 months, since really the low of April post-Liberation Day, FMS exposure to global tech equities has risen by the most since March 2009. You see here the extent of the recovery in sentiment and positioning. There is, yes, the recovery in positioning to tech, but there's also the recovery in terms of profit expectations. We saw over the past 3 months the biggest a rise in optimism when it comes to EPS growth expectation since July 2020, when the world was still battling with COVID. And you highlight here the big conviction from FMS investors. They are very bullish on AI, they are very bullish on tech stocks, and they think that it is going to be tech and large cap AI stocks that are going to drive the surprises during this earnings season.
When you take a step back, it seems as though an increasing number of people are saying they don't like the valuations. It makes them nervous. The complacency, it makes them nervous. But they're reluctant to sell. Hedging seems to be the more credible way to do this. And it really is the truth, even when it comes to U.S. assets, hedge the dollar. I'm just wondering why that's sort of the mantra this time around, why people are so reluctant to sell, even when they say these valuations are making them a little bit nauseated.
Well, Lisa, for those who sold in April, just after the announcement from Liberation Day, they certainly sold the S&P on its way to 5,000, and they bought it back when the S&P had risen to 6,000. So, there is this now anchor memory in investors' memory that when they sell, they will probably buy the S&P at 5-10 points higher. So investors are very reluctant to sell today. But also, I think it's important to focus on the fund manager survey positioning across assets, and it's not on US stocks where you see the big longs. In fact, the exposure to US equities is net underweight. It's on international equities, on international bank stocks, and in particular on European equities and European assets where the big lengths are. And I think the biggest pain trade of the summer would be, yes, a stronger US dollar coupled with lower international equities, lower bank stocks, and a lower euro currency.
Last week, we had JP Morgan's JB Diamond come out and say there's complacency in the markets. Do you think there is too much complacency in the markets when you look at this fund manager survey?
I mean, look, investors are still quite worried about a global trade war. They still view a full-blown trade war causing a global recession as the biggest tail risk. But clearly, they are less worried about this development. Back in April, there was a strong unanimity when it came to the potential downside risk from global trade war. 80% had identified it as the biggest tail risk. This time, it's only 38%. So you see that investors have turned around on the impact and the negative impact of a trade war. They now view the average weighted tariff rate that the US will impose on the rest of the world. They estimate it at 14%. It was 12% last month. So you see that, yes, clearly the risk here is that we see a further escalation on the trade front, because we think that based on sentiment and positioning, risk assets, and in particular the S&P 500, are more likely to react to bad news than good news.
It's always provocative. It is again this morning. Elias, thank you, sir. Elias Galou there of Bank of America on their Global Fund Manager Survey. Have you had sticky toffee pudding before?
I have not.
Does that translate?
Not really.
Not at all. Sponge pudding, toffee sauce all over it.
Is it just
like a dessert?
And I understood that. I mean, I understood that
no.
it was, but I wasn't understanding whether it was the stickiness,
never had it.
whether
Never
it
had
was
it?
the sweetness.
Well, Michael Hahn is English, and obviously he's in London coming up with titles for the research. And when I read it out, I wondered whether actually that translated to a Wall Street audience.
So do us all a service. Please translate the implication of that.
It's like a soft pudding covered in toffee, but they're calling it sticky toppy pudding, which is the market right now.
Thank you. That's
Get
beautiful.
it? Like replacing
wait.
toffee with toppy.
One more time. No, I'm kidding. That's very good.
Please, we're on the same page now. Anyway, what jumped off the page for me is what he talked about very close to the end. Most crowded trade right now, short US dollar. Biggest contrarian trade, and maybe even the pain trade of the summer, short euro, long dollar.
And an increasing number of people are sussing that out. And that's one reason why I keep asking how much this market really has priced in the prospect of these tariffs on Europe going into effect at 30% and potentially having a much bigger hit to the European economy than a lot of people are currently pricing in.
Euro dollar 116.71. We'll move on. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump is threatening to impose new tariffs on Russia over its war in Ukraine. In an Oval Office meeting with NATO Secretary General Mark Rutte, Trump said if there isn't a deal to end the fighting in 50 days, he'll impose tariffs of 100%. He also said the U.S. was sending Ukraine top-of-the-line weapons made in the U.S., but according to him, paid for by NATO member states. Meanwhile, Meta CEO Mark Zuckerberg says the company is building a series of massive data centers to supercharge its AI capabilities. The first one, named Prometheus, is expected to go live next year. Zuckerberg says the company is going to invest hundreds of billions of dollars into data center capacity to achieve machine superintelligence. And in sports, Cal Raleigh is the home run derby champion amid an already historic season for the Seattle catcher. Raleigh, who leads the league with 38 home runs, outlasted Tampa Bay's Junior Caminero in the Derby's final round. He's the first catcher in baseball history to win the event. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, inflation data just around the corner.
I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
In just a moment, we'll catch up with Matt Hornback of Morgan Stanley.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Stocks are positive by 1/3 on the S&P 500, up by 0.5 on the Nasdaq. The next stop for earnings, Citigroup reporting numbers in about 12 minutes' time. Under surveillance this morning, inflation data just around the corner.
There's some persistence there. I wouldn't put too much emphasis on one number. I think it's the trend, and I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
Investors are awaiting inflation data for a read on how President Trump's global trade war is impacting the economy. That data is due at 8:30 Eastern Time. Matt Hornbeck of Morgan Stanley joins us now for more. Matt, welcome to the program, sir. A question we've been asking all morning. We've had 4 softer than expected inflation reads in a row. Can we make it day 5? Can we make it month 5?
Well, John, we think probably not. When we're looking at the CPI fixings market, it was a very unique marketplace within fixed income that focuses on exactly the index level for CPI. We think it's signaling a chance of a small upside surprise. But I think the issue that our economists have been talking about for some time is that they haven't really expected to see the tariff show up in the data until now. So it's not as if the data that we've gotten so far this year has really surprised our economists. But we think that the tariff effects will show up starting in this report. So I would say if we don't see it in this report to any degree, then you'd have to start thinking somewhat differently. But we'll see in just a little bit.
Can we take that a step further, Matt? You said if we don't see it in this report, you have to start thinking differently. Do you think that this is a decisive moment to understand whether the tariffs are inflationary or not?
Well, any one report needs to be taken in its proper context. There are other things going on in the U.S. economy. It could very well be the case that we do start to see tariff-related effects in goods prices. But what's happening in other parts of the economy, in the service sector in particular, just overwhelm what's happening on the goods side. So we need to look at every aspect of the report to make any broader judgments. It's just one report. We've got a whole second half of the year to get through. So we'll, of course, be paying attention to the upcoming data as it rolls in.
It's interesting to me that when we got the last CPI report on June 11th, yields have barely moved. They're basically in the same place. You've seen a little bit of a move on the front end with yields coming in. Globally, though, it's another picture. You're seeing long end yields across the world, particularly led by Japan, surging higher. Does that give you comfort about investing in the U.S., or do you feel like they're just completely different dynamics at play?
I do think, Lisa, that there are different dynamics at play. Oftentimes, markets march to the beat of their own drummers. Sometimes they march to the beat of one. But I think in this case, we're definitely seeing idiosyncratic developments in different bond markets. I can tell you a detailed story about what's going on in Japan, a separate detailed story about what's happening in the long end of the gilt market in the UK, and then, of course, what's happening in the United States. So every market is different, I think, in this moment. It just so happens that the stars are aligning to put upward pressure on longer-term interest rates.
Matt, you used to trade JGPs about 20 years ago. Can you just share with us your experience 20, 25 years ago and just how much this market has changed over the past few decades?
Yeah, I will tell you, I did not expect my experience 25 years ago to be brought up at this point, but here we are. I do think that the long end of the JGB market is just different in the sense that, I mean, the supply picture is largely the same. There's always been a tremendous amount of supply in the Japanese government bond market, but what's different is the demand side of the equation. The life insurance companies in Japan are selling fewer life insurance products to the people of Japan, in part because the people of Japan have other investment options, in particular related to the NISA scheme, which essentially allows the people of Japan to invest for their retirement in a tax-efficient way. That didn't exist 25 years ago. And so there are some different demand dynamics happening in Japan. And of course, because the market is largely a domestic market, those types of structural shifts in demand can have quite an effect on the price, and that's exactly what we're seeing today.
So, Matt, as you know, Japanese investors have a rather large presence in certain European debt markets, in the US Treasury market as well. We've debated on this program now for a number of months as to whether we would see some form of great repatriation as yields start to back up in Japan, whether we start to see a read-through to other markets as the money starts to come home. Are you anticipating that at all, Matt?
Well, I do think that over the course of time, there will be these kind of glacial shifts in investment direction. I don't think that we're seeing it with any particular impulse in this moment. But ultimately, if yields in the long end of the JGB curve continue to rise, those assets will become much more attractive to investors that sit outside of Japan. And so, of course, the price determines a lot in this business that we're in. If the price cheapens up, you're going to see investment capital chase valuation. And so that could be something that defines the second half of this year.
That experience was useful. Matt Hornback of Morgan Stanley. Matt, thank you, sir. As always, appreciate it. That market's changed a lot.
Yeah, it used to not be a market. It was suddenly owned by the Japanese authorities, and now it's starting to become a market again, much to the chagrin of those Japanese authorities that now are looking at yields that are much higher. The last question is really important here, the repatriation of some of those assets and what that does to connect the global markets in a way where they don't become as idiosyncratic as maybe they're trading right now.
Do you remember waking up to those headlines every now and again that would just say the Japanese 10-year hasn't traded today? Do you remember that?
I do.
That's the last decade over in Japan in that market.
If you want to talk about inflation being dead, the Japanese bond yield was dead. I mean, really, it was flatlining for a long, long time because it was entirely owned by the government. But all of a sudden, it's not, and it's gotten a lot more interesting. And Matt Hornbach, thank you for that experience.
That's the focus of the global debt markets so far this morning. So far this morning, we've got through a lot. Numbers from JP Morgan, pretty decent. Numbers from Wells Fargo, less decent. In about 5 minutes' time, we'll hear from Citigroup. About 30 minutes after that, we're going to get inflation numbers. And I think it's important to listen to what we heard from the Treasury Secretary, Scott Bessent, a little bit earlier on this morning about the pressure they're putting on the Fed chair. The pressure now on the Fed chair, not to leave immediately, but to vacate the seat once his term expires to allow them to nominate a new governor.
Absolutely, because he thinks it will cause confusion if a Fed chair stays on as a governor, especially with a lot of controversy around this idea of a shadow Fed chair.
Much more still to come on our conversation with the Treasury Secretary, Scott Bessent, plus Greg Battle of BNP, Jared Cassidy of RBC, Neil Dutta of Renmag, and David Kelly of JP Morgan.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB forum in Central Portugal, and this is Bloomberg.
The tariffs could definitely create some inflationary headwinds.
The effects of the tariffs are actually going to take some time.
We will not start seeing the inflation effects until a few more months down the road.
It's still too early for us to really start to see a wave of inflation.
The risk to us is that we see a more persistent impact of inflation.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equities doing okay, led by the chip sector and some of the biggest banks in this country. Equity futures on the S&P up by 1/3%, on the Nasdaq 100 up by 0.6. 30 minutes away, CPI in America, inflation data at 8:30 Eastern time, and lots of banks in between. Tomorrow, you'll hear from Bank of America, Goldman, and Morgan Stanley. This morning, just seconds ago, we're hearing from Citigroup.
And they joined the JP Morgan side of things in terms of beats pretty much across the board when you look at whether it's investment banking, fixed sales and trading, net interest income, equity sales and trading across the board beating at a time when a lot of people are wondering about the turnaround plan. Citi is going to be interesting that way. And I am curious about how much those shares are going to respond to this because the bar hasn't been quite as high as, say, those shares of JP Morgan.
Sonali Basak joins us now for a sneak peek of what we've seen in the last few minutes. Sonali, I gave the cheat guide for JP Morgan earlier on this morning. I said beat, 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 beat. And I think I'm seeing the same thing on Citi.
So many beats. And remember, for Citigroup, as Lisa had alluded to, it counts a lot more, doesn't it? You had come into this quarter with Citigroup really trading at a lot less than book value still. Came in at the end of yesterday trading at 85% of book value, just about. When will it hit book value, John? That is Jane Fraser's goal here. Now, remember, they had revamped a lot of their businesses. They have new leadership. So the fact that they're beating on fixed income trading, on equities trading, on investment banking, and net interest income. Remember, the other two banks that reported this morning did not beat on net interest income for this quarter. Is very promising for Citigroup, particularly because that bar had been a little bit lower coming in. They're also seeing full-year adjusted revenue at about $84 billion. That is above prior estimates. So beat and a raise for you. Once again, pretty rosy out there on Wall Street today.
Shnali Basak with the latest. Shnali, thank you. That's the latest on Citi. So far this morning for the equity bulls, you're getting everything you wanted and more. A beat for some of the nation's biggest banks, a beat and a raise from JP Morgan, a beat from Citi, reversing some of the chip curves, at least that's expected with regards to exporting into China at AMD, at NVIDIA. If we have a clean sweep, it would need to include, at 8:30 Eastern Time, a softer than expected inflation print.
Immaculate disinflation, ongoing strength in corporate America, ongoing suggestion of strength among consumers at the same time that you're not seeing a read-through of those promised tariffs in some sort of increase in prices for consumers. You get the trifecta, we get a new high. That's what a lot of people are expecting.
And the Treasury Secretary was talking about how one print doesn't really matter, it's the trend. So really leaning onto the fact that before today, we had 4 months of straight softer CPI prints. And they're leading into that when they start continuously this jawbone of Jay Powell. Something else that is good news for the markets, he made it very clear the president is not looking to fire the Fed chair.
I imagine that Fed chair is going to face a lot of pressure if we get another soft read at 8:30 Eastern Time. Social media posts are going to begin straight away.
You can almost draft them. If you get a softer CPI print, Trump is going to come out yet again and said, what did he say yesterday? Inflation is, quote, dead, doesn't exist. Well, there's still some inflation. Of course, the issue that this Fed has is the fact that they haven't set the tariff rates. And having this discussion with the Treasury Secretary, he says we're not going to rush deals based off some market deadline. Well, it's not really a market deadline. It's their deadline. They just keep pushing the can down the road.
The S&P this morning firmer by 1/3%. We begin this hour with stocks higher as investors await key inflation data. Greg Battle of BNP Paribas writing the following. Investors looking to hedge over CPI should consider the Russell 2000. While the vol isn't obviously cheap, the index has been sensitive to CPI surprises. Greg joins us now for more. Greg, good morning.
Good morning.
Let's just get into what you do expect to see at 8:30. Let's start there. What are you and the team looking for?
Yes, our economics team are looking for a print in line with consensus, which is a tick up sequentially to 0.3, both for the core and the headline. I'm not sure that's going to be enough to move the market one way or the other.
Is this a decisive moment in terms of either we see the influence from tariffs or we don't? Kind of the suggestion of this is the month it should show up, and if it doesn't, then you have to rethink things.
I think it's disproportionately important. I mean, you know, one given data point isn't the be-all and end-all, but people are looking for the emergence of that trend to start with this data point. So if we were to see a hot print, I think it would give the market pause for thought.
What would that pause for thought look like? In other words, how complacent has this market gotten to the idea that there hasn't been as big of a real read-through in inflation from the tariffs?
One of the things that we've seen recently in the past couple of weeks has been a large rotation into some of the most shorted names, unloved names, lower quality names. And those are typically names that benefit from a Fed cutting cycle. So I think what we could see is a reversion of that rotation if we were to see a hot print.
So not necessarily a wholesale sell-off, but just sort of shifting around, which seems to be the way people are thinking about things right now.
I think if we got a hot inflation print and that were at the market, you could see two things. One, you could see the market reverse some of the gains, and you could see that rotation under the surface reverse. And in the index space, that would be things like small and mid caps, Russell.
Why would I want to leave what's working so well right now, which is mega cap tech?
Yeah,
and all the right things keep happening, including this morning on NVIDIA and AMD.
Yeah, I'm not sure that you would. I mean, the one message we've had for large cap tech, and you can express this through NASDAQ, is starting to look at delta replacement strategies. This is the idea of owning the upside in the optionality so you can benefit from a trending higher and overshoot if you like, but mitigating some of that risk at all-time highs.
Can we sit on earnings just for a couple of beats? Yep. What are the big tailwinds now for earnings? Because we were talking about the fund manager survey from Bank of America earlier on this morning. Optimism has snapped back around earnings just like that, so quickly, even with all the policy volatility down in Washington, D.C. What are the big tailwinds now?
Yeah, so I think when we think about earnings, they are obviously backward-looking, and they're going to cover second quarter. The macro data in second quarter remain robust. And then we saw a couple of big incremental headwinds. One is the dollar. Massive dollar depreciation Q2 over Q1. 40% of S&P revenues come from overseas. That's just a big mechanical translation effect. The fiscal measures we've seen, one big beautiful bill, that's something we don't think is reflected in the sell-side consensus yet. So there are two kind of mechanical tailwinds, if you like, that should drive some upgrades post-earnings.
At the same time, there's the huge headwind, which is the tariffs, that we don't really have a sense of exactly what the rates are. Is this a market that doesn't think the president is actually going to go through with the rates as he's proposed even over the weekend? Or is this a market that says, even at that pace, it's fine, and companies have shown their ability, as Tom Keene would say, to adapt and adjust?
I think it's a market that doesn't know. So what people are trying to do is to trade the data points as they see them. So we've become a little bit more numb to the headline risk, and instead people are going to try and trade the data. That's why CPI today is super important, and earnings season.
The Treasury Secretary was talking about how the narrative of obsessive focus on the market is not right. And then he says, I'll tell market participants not to worry on August 12th. That's when the détente, that deadline is up between Beijing and Washington. So if they're telling you not to worry about these deadlines, do you just take everything that's coming out of the White House right now as pure negotiating tactics?
You can see that the market isn't really worried about the deadlines, because you can look in the options market and see where risk premium is priced. Risk premium is priced for things like today with the CPI print. It's priced for the FOMC. The deadlines coming out the White House do not see kinks in the volatility surface that suggest people are trying to hedge those specific dates.
Is that because people believe it doesn't matter, or because it won't happen? Because there are two very different interpretations of all of this. Lisa talked about the adapt and adjust that TK would always talk about with companies. Certainly there is some evidence of corporate resilience. Is it that it doesn't matter, or is it won't happen?
I think it's more that people are uncertain as to whether it happened or what extent it will happen and where will you see that impact. And I think that at the moment people have tried to trade the headlines, it hasn't really worked, so people are taking to trade the data instead.
I've struggled with the data. Never mind trading the headlines, I'm struggling to trade the data. When we get these numbers in 22 minutes' time, if it's softer than expected, and I've got no idea what the number will be, some people will say that's signal. Companies are handling it well, maybe they have to take it on margin, they can't pass it along, whatever. Other people will say it's noise. All this is pre-tariff inventory, we're still working through it, wait. Just wait, and you'll see it eventually later on in the summer. That was the argument the month before. We're going to hear that potentially again at 8:30 Eastern time. How much can you read into the economic data that we're getting?
I think sequentially as we move forward, you start to read more into it. I don't think anyone expected the backward-looking data at this point to show anything, but I think people do expect there to be, the early signs of impact in this print and into the next print. So this print, the next print, I think if they were very soft, it would be hard to look through that.
This market's been trained, conditioned by experience. When in doubt, just buy. When in doubt, just look through everything. It's just going to be noise. Does that create a certain fragility? The lack of a response function in markets to headlines that could potentially be transformative and potentially facing a rude wake-up call.
Yeah, I think it really increases the risk that we overshoot. People become numb to the headlines around tariffs, and then if you were to see an actual economic impact, if that comes later over the next couple of months and people have managed to rebuild those equity longs, then it can be more impactful.
Great battle of BNP Paribas. Greg, appreciate your time. Next stop for this market, 8:30 Eastern time. I have no doubt, whatever the number will be, the debate will continue.
Right now you have ranges in terms of estimates on Wall Street from 0.1% to 0.4%. That's a pretty big delta. So you're looking at people who have their finger in the wind trying to figure it out, and it seems like everyone has a different answer.
Might not sound like a lot. Might not sound like a lot.
It is.
But you can drive a truck through that. That's a big spread on Wall Street.
Especially because it's not just headline. This is actually even in core. When you strip out energy and food, it's the same range. People don't understand the response function from corporations that have set contracts with their suppliers and are trying to figure out what they're going to do with all this.
The difference between 0.1 and 0.4 is a very different conversation at the end of the month on the FOMC. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. We start with Citi results. Traders there posted their best second quarter in 5 years. Revenue from the bank's fixed income trading business soared 20% to $4.3 billion, beating the $3.9 billion predicted by analysts in a Bloomberg survey, while Citi stock traders hauled in $1.6 billion, boosted by volatility amid President Trump's trade war. Meanwhile, the Port of LA saw its busiest June ever after a slump in May, with the whipsawing trade war pushing shippers to beat shifting deadlines. But trade forecasters expect a severe drop for the rest of the summer and through the holidays starting in November, which is typically peak season at the ports. And Andrew Cuomo's bid for New York City mayor is not over. The former governor announced he intends to run in the general election in November. Cuomo's announcement follows his decisive loss to upstart Zohran Mamdani in the Democratic primary. Cuomo will pledge to drop out if he isn't Mamdani's highest polling opponent by September. That's according to a person familiar. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, the morning calls, plus Gerard Cassidy of RBC Capital Markets with bank earnings underway from New York City. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Be a judgment that the Chinese indigenous manufacturers already have an equivalent chip. So if there's an equivalent chip, then the NVIDIA H20 could be sold. One thing that we do not want is a digital Belt and Road springing up around the world because other countries or China are substituting for our American chip manufacturers.
It's a change in Washington, D.C. That was the Treasury Secretary, Scott Bessent, on these chip manufacturers. NVIDIA up in the pre-market by 4.5%. AMD up by close to 5%.
This is the same administration that in April said you cannot export this chip. The concerns were about national security. Now they were saying this was a chip in the negotiations. It was part of the, quote, mosaic of the trade talks in Geneva and London with China. And then when it comes to that August 12th deadline, the Treasury secretaries, I tell market participants not to worry.
All I can say is Jensen Huang has a front seat. And this is the view he's been putting out there, digital Belt and Road. And if you want to compete in terms of international use of U.S. technology, you cannot have these bans, et cetera. That's gaining clout in the White House. That's what that meant to me, given the fact that Treasury Secretary Bessent really referred to that kind of idea.
I think it's more than just having a front seat. I think he's almost driving the car. This is an individual that went and met President Trump. Now you see this reversal. He announces it himself on his blog and in China to his Chinese customers. This was the person that also really was pushing this administration to get rid of the diffusion rule, putting the world into AI buckets on where and how they could export some of these chips. And the Trump administration did that. And he is getting a mass amount of money flowing in from the Middle East, and now he's going to get back on China's market.
There's some big moves in the pre-market. Those two names driving gains this morning. Equity futures on the S&P higher by 0.3%, on the Nasdaq up by 0.5%. That's the price action. Here are your morning calls. First up, Morgan Stanley downgrading Freeport-McMoRan to equal weight, coming ahead of a 50% tariff on U.S. copper imports. Elsewhere, your second call from JP Morgan downgrading SolarEdge to neutral, pulling back after the stock's outperformance since May. That stock is down by 1.65%. And finally, Jefferies downgrading DoorDash to hold, saying there is not enough to justify continued outperformance. That name is down about 1% in early trading. Let's turn back to the big banks. JP Morgan and Citi beating expectations. Wells Fargo cutting guidance and missing net interest income estimates. Joining us now is Bloomberg's Sonali Basak. Sonali, a few different stories there already this morning.
Definitely. You have JP Morgan, as you say, beating expectations as well as raising guidance, which is a welcome news for Wall Street. However, John, one question I still have, and we have to wait till the calls to hear exactly what executives say about this. Credit quality has held up remarkably well. Loan growth has expanded in the credit card businesses in particular. But if you look at it in the current quarter, even if JP Morgan raised their expectations for the year, for JP Morgan and Wells Fargo, net interest income came in below expectations. Is there a bit of caution? Even if you're having good numbers flow through the banks, is there caution when it comes to meeting the consumer? JP Morgan CEO Jamie Dimon and CFO Jeremy Barnum are now talking to media, talking about that caution and how easy it is to get complacent at this level. I want to point out they also nodded to what Anne-Marie was talking about a little earlier. Certainty when it comes to the big, beautiful bill. It gives confidence to corporate clients to move forward. And you do see them starting to capitalize on those Wall Street businesses, which bodes very, very well for Morgan Stanley, Goldman Sachs tomorrow. What I'll be watching for today is, are you going to be in a situation where Morgan Stanley's price to book ratio here actually jumps past that of JP Morgan because they are so much more weighted in those Wall Street businesses? That could be a good barometer for you in terms of how Wall Street feels about these businesses.
Look for that in the next 24 hours, Sonali. Thanks for the recap. Appreciate it. Sonali Basak happened to lead some of the coverage of bank earnings this quarter. We have had a stunning rally over the past few months, a rally of more than 38% off the lows of April for the KBW Bank Index. To discuss, RBC's Jared Cassidy joins us for more. Jared, a rally of almost 40% on the bank index. Do you see enough this morning for this rally to continue?
John, I think it certainly supports higher valuations. Now, certainly we're not expecting that kind of move over the short term, as we just experienced, as you pointed out. You know, understanding, of course, the bank sold off very hard from the February highs into that early April time period. But it's not only the results that are driving these stocks higher. As you and I have chatted in the past, it's really about the deregulation opportunities for the banks, and that's a big support for the bank valuations at these prices.
Gerard, how do we understand what's been priced in? That's been the big concern with the likes of JP Morgan, and that's the reason why you're not seeing a response even after beat, as John summed up. You know, how much can we understand the deregulatory impulse as well as a pretty steady economy and rates relatively high? How much have we really factored that already in the price?
That is the $64,000 question, Lisa, because it's very hard for investors to really determine with a high degree of calibration of how much is priced in. Certainly something is priced in, as we all know. The question is it all priced in? And I think what we'll have to wait and see is, as we enter into the fall and we see what these new guidelines will be for the Basel III endgame, that will determine how much really is priced in. We expect the results or the proposal when it comes out to be quite favorable for the banks. So certainly a portion of this good news is clearly priced in. The question, as you point out, is it all priced in? We don't think so, but a good portion of it is.
Right now, the call for JP Morgan is ongoing, and Jamie Dimon has come out, a couple of headlines here. I'm not listening to the call, obviously, we're here. But some of the headlines include this: independence of the Fed is absolutely critical. Putting aside this question about the independence of the Federal Reserve, what would happen if the Fed dramatically dropped interest rates? What would happen to the outlook for banks, given that they've really benefited in terms of where rates are currently?
It's interesting because you certainly don't want the Fed funds rate falling back down to the levels of where it was right after the pandemic of 0 to 25 basis points. And I'm not suggesting even in our first rate cut we'd ever see that. But if we can have a gradual decline in the Fed funds rate of, let's call it 75 to 100 basis points over the next 12 months, that is still very favorable to the banks. It's really kind of off the cliff drops that would be disruptive, meaning if we got a 100 basis point rate cut, which again, nobody's expecting, but that would certainly be disruptive. But a gradual decline of 75 to 100 basis points at the front end of the curve and the long end of the curve stays anchored around 4.5%, we would view that very favorably for the banks.
Jordan, I'd love to get your take on the tariff volatility. It's clearly been an opportunity for these banks when it comes to trading, but at the same time, they do talk about this uncertainty that still lingers overall in the economy because of that uncertainty. Do you think that the volatility that's emanating from Washington, D.C. has been helpful to these banks, or more so that they would rather clear-cut clarity as soon as possible?
It's a mixed blessing, actually. When you look at the money center in the investment banks, the trading revenues for these companies are much greater in size than the investment banking revenues. Trading revenues benefit from increased volatility. Investment banking revenues, not so much. So from that standpoint, you would certainly say from a pure investment banking trading standpoint, they've benefited. On the other hand, however, when it comes to corporate lending and borrowing, the uncertainty is weighed, I think, on the loan growth prospects for the industry. So that would have to be on the negative side of the ledger when it comes to all of this tariff talk and the uncertainty associated with it.
Jared, final couple of questions. Next time you're here in Manhattan, when you walk down Park Avenue and look up, you can't miss it. The tower is basically completed now. And a lot of people thought once the tower was completed, maybe we'd hear something about Jamie Dimon's future. And I wonder, Jared, from your standpoint, how close we are to seeing that headline drop across a Bloomberg terminal that said Mr. Dimon has decided to call it a day. How close are we?
John, I think if I was asked that before their investor day, I would have said it maybe sooner than we all realize. But Jamie Dimon made it very clear at his investor day. He's, having a time of his life. He's having a lot of fun, and he's delivering great numbers, and he has no real plans of retiring anytime soon. So I think we're going to have to wait longer than when that tower is completed for him to announce his retirement.
5 more years?
No, not 5. I would put it less than 5. I would, if you had to be a betting person, probably he'll retire in the next 2 to 3 years. But that's just a guess on my part. I have no insight on his retirement plans.
Jared Cassidy of RBC Capital Markets. Jared, appreciate your time, sir. As always, thanks for this morning. Working through numbers from JP Morgan, from Wells Fargo, from Citi to the future of Jamie Dimon. Apparently it's not 5 more years, but it's certainly not just 1.
I have a theory, which potentially, if you have President Trump in the White House, and President Trump clearly respects Jamie Dimon, and Jamie Dimon can say certain things, and he clearly had an impact on President Trump, then if he stays in at the helm of JP Morgan for the remainder of President Trump's helm, then when President Trump leaves, then, we could start talking about politics again.
Besson to the Fed and Dimon to the Treasury.
I don't know. I'm just thinking out loud. So,
Democrats are idiots. That was a line he used recently. I don't know if that was an audition for a seat that might be opening.
You can collect them. Collect the quotes, I'm just throwing out there, this would make sense for him to be in that role and then to, look for a better.
The tower's not open yet. The man clearly wants to hold court, at least for a year minimum.
Cut some ribbon.
In his tower.
Do all of that, take some photos.
Have you ever been to a ribbon cutting?
No, I haven't.
It's really, I've always, the sort of pomp and circumstance, the size of the scissors, the size of the ribbon.
The idea of smashing the champagne against a boat. It's more my scene than a ribbon cutting.
Is that so? Yeah, you seem like a real champagne.
Isn't that more your scene, sort of smash champagne against boats?
Definitely. Ribbon cuttings are underwhelming.
Yeah, I'm not into that.
I don't like the broken glass, and if you go down on the bottom, you cut your feet. All right, let's move on.
Serious stories up next. We've got US CPI. You wouldn't know based on this conversation. Neil Dutta of RenMac joins us in just a moment. David Kelly of JP Morgan Asset Management here to react. We've had a string of softer than expected inflation reads in the United States of America. We've had 4 months of it. Will this be month 5? The data drops in about 5 minutes' time. Going into it, your scores look like this. Equity futures on the S&P 500 firmer by 0.2%. Bond yields are higher at the front end by 3 basis points going into this, 393.
down to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immense.